please.
Okay, we are good to go.
All right. Hello, everyone. I guess good to go means I can start.
Yes, please.
Right. Good. My name is Musa Bagudu. I am your facilitator this afternoon. I know you've had some topics covered, so it is my difficult task this afternoon to take the class after lunch. Not too bad. I will try to do that. Mine is to take you on fixed income. And we have 2 hours to do that. Now, just to let you know that fixed income has 2 study sessions. In terms of weight, we are looking at average of 11%, minimum when you look at minimum 10, maximum of 12%. So the average is like 11%, about 11% of the exam, basically. I want to say that with these study sessions, the 2 study sessions, we have 6 readings. So the first study session has 4 readings, and then the second study session has 2 readings. Now, I have been taking this fixed income for a while, so I have some kind of experience over the time as regards the change in the curriculum and then the consistency of some of the topics in the curriculum. I would like to emphasize that for fixed income, you want to basically understand the first and second reading as they are tied together. So the basic elements of the fixed income. And then the reading on the introduction to fixed income valuation will be very important, very critical for the exam. The reading on interest rate risks is risks and return is also another area that I will emphasize that you need to know. If we look at learning outcome statements, and if learning outcome statements are indications of what is seriously important, you'll see that those ones that I just listed have heavy learning outcome statements. So my presentation will take first an overview of the learning outcome statements, and then we take some questions on the topic areas. I intend to take some time on the first study session, maybe 1 hour, 10 minutes on the first study session, and then maybe about 40 minutes on the second study session. Because of the importance of fixed income in the next level, it is important you get a solid understanding of fixed income to ease your movement through the level 2 curriculum and then level 3. The good thing is that this is a foundation. So the only thing you need to know here is about the basics, and that is all you need. Another thing is the use of calculator is very important. I will emphasize that you make very good use of your calculator. Use the calculator. You have spent so much money to buy the calculator. So I expect that you want to use the calculator to your advantage. Allow it to sweat. You have heavily invested in it. So please take your money back. It is a payback time. Use your calculator wherever possible. And then when we start the class, I want you to, again, make sure that you are following us in solving the questions, because when I bring out the question before I solve it, I will give you some time to just indicate what the answer is. The chat box is available, just chat in your answer, and then I will be following to make sure that we are together in that area. Now, we have laid down the background. Let's just start, and then remember it is fixed income. So my name still remains Musa Bagudu. Let's go on. Follow me. I will take on a wide screen. Now, gentlemen and ladies and gentlemen, the idea with the fixed income is that First of all, you need to understand what this fixed income is all about. It is an instrument. I can say it is a contract, a contract that defines a relationship between a borrower and a lender. So the document, usually we say it's an IOU. The document is just an instrument that represents a lending relationship, a borrower and a lender relationship. Now, in this sense, for every fixed income instrument, you must have, for every fixed income instrument, you must have the 5 basic elements of the fixed income instruments. The 5 basic elements, we have the issuer, we have the maturity, we have the par value, we have coupon, and then we have the major one that we call the currency. Now, the issuer is the borrower. The issuer is that person, or that entity that in the beginning takes in the money, that is borrowing the money, and that is the issuer. In this sense, we have different kind of issuers. We can have an issuer called the sovereign, which is a government, or you can be non-sovereign, which is a non-national government. So non-sovereign can be municipal, can be, in our area, we say it's a local government, or it can be a state government. We also have the quasi-government. These are the agencies of government. So if you have an issue from an agency of government, we say it is quasi-government. So these ones will be agencies actually created by the Act of Parliament. We can have what we usually call the supranational entities. Supras are issues by supranational entities. If I have an issue by the African Development Bank, that would be an example of a supra. If I have an issue by the European Development Bank, that would be another example. And then finally, we have the corporates. These are the private issues by the private entities. Now, why do we want to know the issuer? Because the issuer is the person who is going to be guaranteeing the repayment of this instrument, is the borrower, remember? And so the issuer, the issuer or the credit standing of the issuer determine how good that instrument is. Remember I already said is a borrower and a lender relationship that is being represented. So we need to know the credit quality of the issuer. We need to know so many things about the issuer, and we'll get to discuss these things as we go on. The next one is maturity. Maturity is how long it takes the bond to pay off its principal. So the par value at the end. How long is it? So the maturity, the importance of maturity is that it defines whether an instrument is going to be classified as a money market instrument, or an instrument is going to be classified as a capital market instrument. A money market instrument will be an instrument that has a life or a maturity of 1 year or less, while a capital market instrument will be an instrument that has a maturity of more than 1 year. And this maturity is defined as maturity from the day, from the origin. The original maturity of the issue defines whether the instrument is a capital market or a money market. Before I proceed, I just want to make sure you capture this very well. And so I will ask a simple question. Now, if we have an issue that has been issued, say, 15 years ago, it has been issued 15 years ago, and now you have only 6 months remaining to the end of the life of that instrument. Would that instrument be classified? Would that instrument be classified as a money market instrument or a capital market instrument? Just a second, chat this up. Let me see your response. Capital market, money market, what will you call this instrument? Remember, it is just 6 months to maturity. Remember, it is 6 months to maturity. Was issued sometime long ago, but just 6 months to maturity. Money market or capital market. Yes, I've been getting some good responses coming in. So the answer is going to be a capital market instrument. Ladies and gentlemen, it doesn't matter whether it is 6 months to maturity or whatever. What we are concerned about is the original maturity. How long was it from that time, the original maturity? As long as it is more than 1 year, it is capital, it is in capital market. And then remember, when they give you that name, when they name you at the beginning from when they named you, you don't change names. You know, I mean, you don't change your surname, you carry it to the end. And so that is what it means. If I'm a capital market instrument, I will remain a capital market instrument to the end of life, even if it is 2 days to maturity. Beautiful. The next one is the par value. The par value usually represents the amount that will be paid back at the end of the period, or another way of saying it, sometimes it is the amount that was actually collected from the investor from the beginning. And that amount, the par value, is basically important because the coupon rate that we're going to be looking at next is based on the par value. And then the par value, also another importance of the par value is when we look at the relationship between the par value and the price of the bond, it determines whether the bond is at par, at premium, or at discount. The price of the bond also, the price of the bond is reflected as a percentage of the par value. That is what you know about that. So many things we're going to be looking at. The par can be paid as a bullet. You can have a different kind of repayment for the par value, which is called the principal amount or the redemption value. The next one that I want to talk about, because I just want to move on, is the coupon. The coupon rate. The coupon rate is different from the coupon, right? The coupon rate is that rate that you use as the payment, as the fee, or rather what we call the cost of money. You know, the cost of money is said to be the interest rate. The coupon in this sense represent the cost of the issuer is paying the cost for the use of that money. And remember, I said it's a percentage of par. So if it is the coupon rate is 5%, it means, and the par value is 1,000, it means the coupon would be 500 with 5% of 1,000, and that is what the coupon will be. It's very important to distinguish that. The coupon can be fixed. So all through the period, it's fixed. The coupon can be floating, and we have that for a floating rate note. The coupon can also be zero. If the coupon is zero, please remember, it does not mean that the instrument does not pay coupon at all, does not pay interest. If you have a question that is asking which of these instruments does not pay interest at all, remember that because it's zero coupon bond does not mean that it does not pay interest. The difference between the discounted amount when you are buying it and the par value that you get at the end of the period is effectively representing the price for the use of money, which is interest in a sense. Now, the next one is the currency. The currency, every instrument must have a currency of issue. The currency of issue determines so many things. Now, if we say, remember when we say if interest rate goes up, the price of the bond will go down. The interest rate that we're talking about is the interest rate of the currency of issue, and that is the importance of the currency. So if a Nigerian government, and this is a question again that I'm asking you, if a Nigerian, after what I just said, if a Nigerian government is issuing a security in US dollar, if the Nigerian government is using a security in US dollar, and the Central Bank of Nigeria increase the interest rate goes up, what happened to the value of this bond? Again, chat up, let me know what your thinking is. The coupon is dollar denominated. Nigerian government or the Central Bank of Nigeria increase interest rate. What happens to the price of this bond? What happened to the price of this bond? The price of this bond, what happened? Yes, the price of the bond will remain unchanged because the bond will respond to the interest to the interest rate of the dollar and not the interest rate of the Nigerian entity or the country Nigeria. Now, we have two types that we needed to know in terms of currency bonds. We have dual currency bond, and then we also have the currency option bond. The dual currency bond is the bond that gives you gives you payment of coupon in one currency and also the payment of principal in another currency. that those two currencies are determined at the beginning. The next one is the currency option bond. This is the bond that gives you the option. When I say you, is the investor, that gives the investor the option to choose among two currencies to get the cash flow that will be coming. Remember, I said these things, what we just finished talking about, these things are elements of the fixed income instrument. These elements of the fixed income instruments are all contained, are all embedded in a contract document called the trust deed. Called the trust deed. Another name for the trust deed is the bond indenture. Now, the bond indenture is that document, that big contract document that defines those basic elements of a contract. In addition to those things that we just listed, the trust deed or the bond indenture will contain some other things. I call them the famous C's: credit enhancements, covenants, collateral. All these things are contained in the trust deed. In terms of credit enhancement, I would just say in terms of credit enhancements, you have what we call credit enhancement. You have what we call the internal credit enhancement, and you have the external credit enhancement. Credit enhancement is what you put to the contract, what you put to the issuance of the bond, those things that you make to make the bond to be more attractive, to improve the security of the bond. So it reduces the cost of issuance. In this case, you have you have three types in the internal. You have subordination, you have over collateralization, and then you also have the excess spread. These are the three types that you have: subordination, over collateralization, excess spread. You will need to just understand this. The internal is, as in, it is part of the structure of the issuance. So, then we have the external. You can have, it says LBS, somebody says Lagos Business School. So the first one is the LC collateral, LC. So it's the LC, when you have an LC that is issued by a financial institution to say if anything happens, you have a line to draw from, it will be an external enhancement. If you have a bank guarantee that is issued by a financial institution, it also serves a surety bond by an insurance firm will also serve as an external enhancement. External enhancement is just as good as the person providing the enhancement. If you give me a guarantee, it means what you have done is you have improved the quality of that instrument to the level of the guarantor, which cannot be better than the guarantor. It does not remove credit risks, only that it is improving it, making it look, making the instrument to take the credit risks of the guarantor. Sometimes you have to have a cash collateral where, you give me an LC, I will just take the money that instead of waiting, I will just draw the money, put it somewhere as cash collateral in a cash collateral account where we invest. So I'm borrowing it to invest it to gain interest, but then it is serving as a collateral in a way. Then in terms of covenant, remember we have two types. Covenant can be affirmative, and then covenant can be negative. Affirmative is what we also call the positive covenants. The positive covenant is just those covenants that they are called administrative, right? They'll just say, we promise, as in we'll do this. The company, those things that you expect the company to normally do, actually. So it is not restrictive like the negative covenant. The negative covenant will restrict the ability of the entity to do some things. So if you say that the entity, if the covenant says your debt to equity ratio should not be above a certain amount, or the entity should not borrow any debt that is going to be ranking higher than the present debt, that will be a restrictive covenant. The last part that I want to look at and talk about is the collateral. And then in terms of the collateral, we have different types. And if the collateral is financial assets, If the collateral of the issue is financial, a pool is financial asset, we call that bond a collateral trust bond. If the collateral is specific equipment, say a physical asset, we'll call that equipment trust bond. If it's a pool of mortgages, we call that mortgage-backed securities. If it is another one that we have a pool of assets and it's issued by financial institution, we call it a covered bond. For covered bond, the advantage of covered bond is the fact that unlike the MBS, the covered bond has dual recourse to the issuer and recourse to the pool of mortgages. We have so many other things to talk about in the part of the reading. There's also an element of the reading that we needed to look at, and that is the part of the reading that will discuss the kind of market. We have different kind of markets. We have the national bond market and we have the Euro bond market. The national bond market, I've moved somewhere, national bond market. For national bond market, they are into two. We have the domestic and then we have the foreign. We have the domestic and then the foreign. And then the national bond market, we have two types of the national bond market. The domestic and the foreign. And then we also have the Euro bond market. So very important to distinguish the two. The national bond market, when we say the domestic bond market, they are market for domestic bonds, they have to be issued in a certain jurisdiction in the currency of that jurisdiction. So issuance in the currency of that jurisdiction. So we usually say they have to be registered in the country. So for example, so I'm saying they have to be domiciled in that country, issued in the currency of that country. And then we say they have to be registered. So if you have MTN Nigeria issuing a bond in Naira, it will be a domestic bond. If you have MTN South Africa issuing a bond in Naira, it will be a foreign bond. So in a foreign bond, the entity is foreign, as in the entity is not domiciled in the country of issue. Then we have the Euro bond, which is issued internationally in the Euro bond market. And so it's not, there is no one country jurisdiction. It is outside the jurisdiction of one country. And then, so if I have a Nigerian government or a Nigerian entity going to that international bond market to issue, in the Euro bond market to issue a dollar-denominated bond, that would be a Euro bond. That would be called a Euro bond. It can be in another currency. If you can have it in US, in GBP, you can also have it in Euro. If it's Euro, it's not Euro bond. It will be Euro-denominated Euro bond. If it's in the US, Japan, for yen, you can have Euro yen. You can have Euro dollar and all that. All right. So foreign bond, Euro bond is not registered. Euro bond is not registered. Foreign bond has to be registered. Foreign bond and domestic bond, they are all registered in one jurisdiction, in a certain jurisdiction. They have to be registered in a certain jurisdiction. The difference between domestic and foreign is the fact that one country, for foreign bond, it is issued, for the foreign bond, it is issued by an entity that is foreign to that country. But then the major thing that you need to know is that they have to be issued in the currency of that country. So, but then Euro bond, I said, it's issued in the international bond market, but then the currency is not a currency of any particular, it's not a currency of that place. So for example, if the Euro bond market we decide to go to is the London Euro bond market, for example, and we issue, the Nigerian government, for example, issue in USD in the London international bond market, or what we call the Euro market, this will be called Euro bond. Now, in Euro bond, there's no registration. So it's usually called a bearer bond. There's no registration. There's no domiciliation. It's not registered in one country. So we call it a Euro bond. Now, we can have a bond. I don't know if that is clear. So look for the difference in terms of, look for the currency. The currency will be different from the currency where the issue is done. And then look, another thing to do is also looking at the foreign bond and the domestic. We said the national bond market. So you can have an instrument that is registered in the national bond market. It's registered. That will be, so if Nigeria goes to New York to issue a bond, it will be in US dollar, it will be a foreign bond. Thank you for the answer. So that will be a foreign bond and it will be registered in US, just like the example I gave. If you are going to issue in the currency is in the currency of the country of issue, then it is just a foreign bond. Foreign bond will be registered. All right. Now, and the good thing about the Euro bond is that it is traded internationally, so not in any one jurisdiction. You can have a global bond. It's registered in one jurisdiction, but then it's traded internationally. That will be a global bond. So it has a presence in terms of national bond market, but then it's also traded internationally, and that will be a global bond. All right. Now, let's quickly, because we have so many things to look at. I have coupon payment structure to look at. If I have FRN, I have how is the payment structure. We also have the type of coupon, step-up coupon, credit link coupon, payment in kind coupon, deferred coupon, index link coupon payment, or those kind of things. There are so many things that you know. Also, in terms of bonds with contingency provision, we have callable bond, putable bond, convertible bond, contingent convertible bond, and then we have warrants for us to look at. What I will do is I'll bring up questions. When we're answering the questions, we may be explaining some things. Just know that some of these bonds, they will favor. Some of these bonds will favor the issuer. Sometimes they will favor the investor. A callable bond will favor the investor, will favor the issuer. A putable bond will favor the investor. Now, anything that favors the investor will mean that the yield will be low. Anything that favors the borrower, it means that the yield will be high. So anytime you see anything in the fixed income market that favors the issuer, it means that it will mean that the yield of that bond relative to another will be higher. If it favors the investor, the yield will be lower. That's what that means. And also with some bonds, in terms of tax implication, sometimes the country where it's issued, the bond will be, the tax is paid for the country. Remember, it is just about capital. The tax that we relate here will be the capital gain tax that will come when in terms of what is being added. And then we also have the tax on the income that you earn. These taxes are applied by the different jurisdictions, and the different jurisdictions will have different ways of applying their taxes. There is original tax discount, original issue discount. With this, what it means is if I issue a discount bond, for example, the discount bond is this is just for other jurisdiction. If you issue a discount bond, remember you pay, for example, 90 and collect 100 at maturity. The difference between 90 and 100 is 10. For other jurisdiction, they will not wait for you to take this 10 before they apply before they tax the income. They will just take this and prorate it into the different year. If this 10 is for let's say it's for a 5-year bond, zero coupon bond, then it means that they would they will divide that 10 by 5, and every year, two naira will be, or $2 will be considered to be earned income, and this earned income will be included in the taxable income. But this is different depending on the country. If some countries will allow it to go to the end when you collect the income is taxed, some will tax it prorated. All right. So let's take some questions, and then remember how we do these things. You have to put in your answer. As I bring up the question, just put in the answer. Let me know you have an answer. Which type of fixed income security is most likely to have a coupon payment that resets periodically? What's your answer? Just put in the answer and I will know. Yes, try it. You are measuring yourself, and then also sometimes it's good to have an opinion, so that if it's not that, so floating rate note will be it. We are starting like you have. We are starting the way you have this. Correct? Correct. So I'll move on because we need to move. Yes. This is important. What's the answer to this? We have finished the first one. So question 2, what's the answer? Sharp. Look at it. What's the answer? Time is going. What's the answer? A, B, or C? A, B, or C? A, B, or C? Exactly. Do I say time up? Okay. Almost everybody gave me the answer of this. A coupon, those kind of coupons, those floating rate notes, they pay in arrears. So the coupon rate at 31st December, we use the LIBOR. We use the LIBOR as at 30th June. We use the LIBOR as at 30th June. So you have to have 1 plus 6% plus 0.5%, and that will give us 2.1%. Right? Beautiful. It seems my people are ready for this. Yeah, let's continue. And then keep the momentum. Keep it on. What is best described in the following statement? Just give me the answer, and then we are good. Yes. Beautiful. I said my people are good. I hope you just maintain the momentum. Yes, we mentioned this. The analyst is describing a bond indenture. This is a contract between an issuer and investor, specifying the obligations of the issuer, payment options, identifying the trustee, listing all covenants and all that, right? Yes, we have moved. So here now we can have some variations. Yeah. So which of the following is least likely? When you see it, remember what we are saying is least likely. So it is not to be a negative. It's not a negative contract associated with coupon paying corporate issue. We are saying it is not. So when we say it is not, the requirement to pay withholding tax to a foreign government is in a timely manner. This is a normal thing that the company should do. Remember when I said one is restrictive, one is administrative. A negative covenant is a restrictive covenant, restricts the entity on the ability to do things, while the administrative is just a normal administrative covenant. So things that you should normally do. I will service the asset, right? I will pay staff as at when due. Those things are administrative in nature. Yes, we are moving. Which of the following embedded option is most likely to provide a right to the issuer? Which one now? Yeah. Yes. A right to the issuer. A right to the issuer, beautiful. So a right to the issuer will be a call feature. A call feature will favor the issuer. The right to the issuer will be a call feature. Conversion provision is for the investor. Put feature is for the investor. Go on. Which type of bond is most likely to be preferred by investors in a falling interest rate environment? This is yours again to shine. I hope you are keeping record of how many ones you've gotten correctly. All right. Make sure you are reading the questions very well before you answer. You know, understanding the question is part of the examination. They used to tell us that one. So a cap. So which one is most likely preferred by investor? If a cap floating rate would just say that the interest rate or the coupon will not go above something, that will be good for somebody who is paying the coupon. So it will be good for the borrower. Yeah, this will be good for the borrower. The floor, we said the interest, the coupon you are going to pay me should not go below a certain amount. So this will favor the investor. When you have a floating rate note with no cap and no floor, so this one is just a floating rate note, and you cannot determine who exactly is benefiting depending on what the direction of interest rate is going to be. Usually when you buy a floating rate note, you want to be expecting that interest rate will go up, and that is why you buy in the interest rate bill. So let's move on to the next one. Yes, quickly, don't waste time. You know, don't pretend as if it's a difficult one, so that you think that if we're pretending, we'll think that it's difficult. We know that it's not difficult. Just answer the question and we move on. Yeah, internal credit enhancement, we say which one is least likely. Usually when I see least likely, I will just say it is not. I will say it is not. And then I will just move so that I won't be confused. Beautiful. I hope you will keep the momentum. Now this one, we want to know which one it is least likely again. What's your answer? I think this example should give us a good example of what it means when we say a Eurobond. Which one of the following is least likely to be an example of a Eurobond? So you have a Japanese company issuing euro-denominated bond to investors domiciled in UK, but it is euro-denominated bond. So here you have an example of a Eurobond. You have an Australian company issuing a US dollar-denominated bond to investors domiciled in Japan. Here you have an example of a Eurobond. A UK-based company issuing Japanese yen-denominated bond to investors domiciled in Japan. This will be a very good example of a foreign bond, and that is the answer. You see what I'm saying? Now you know. So let's move on. Make sure you are recording, you are putting them together. At the end of the day, you tell us how you have performed. What is the answer here? Don't pretend that it's a difficult question. It's not. Okay. Okay, when compared with an option-free bond, yeah, you are correct. Most of you, I'm saying it. As I already said this, whatever benefits, if the issuer is benefiting, the yield will be higher. If the investor is benefiting, the yield will be lower. The yield will be lower. Take that and take it to the market. Enjoy yourself. Let's move on. I will leave this question I'll bring in this question so that we just move. Yes. What type of bond is this? What type of bond is this? Yeah, what type of bond is this? Yeah, keep it coming. What type of bond is this? All right. All right, beautiful. So, the good thing is when I looked at it, I saw that we have all the options. So we have A, we have B, we have C, meaning that whoever put this question together has done a very good work. This type of bond is called an inverse floater. An inverse floater are floating rate notes that have coupon rates that vary inversely to a reference rate. So when the coupon increase, when the reference rate increase, the coupon rate will decrease. When reference rate, so LIBOR goes up, the coupon that you are going to be paying will be going down. So there is this inverse relationship between the coupon rate and the reference rate. And this is what is called the inverse floater. A floating rate note will have a direct relationship. For a floating rate note, if the reference rate goes up, the coupon rate will also go up. This is an example. So when you have a coupon rate that is made to look like this, L times the reference rate, this will be L meaning the spread. So if you have anything that looks like this, then you know that this thing is, when you have a minus sign in between, then you know that this thing is if an inverse floater. All right. What of this? I've said this. So what's this? Dun, 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 dun. Collateral trust bond. What is called collateral trust? Good. I like the confidence that you're posting. No wasting of time. Collateral trust bond must have an asset, a physical asset of equipment as its collateral. When the pool is backed by, it's a pool of mortgage. When the collateral or security is pool of mortgages, it's called a mortgage-backed security. When it is financial assets, common stock or bonds, it is called collateral trust bond. It is called collateral trust bond. Good, good, good. So far, so good. Equipment trusts. Sorry, I think I've explained this, but marked it wrongly. Collateral trust bond is backed by a pool of assets. Equipment trust bond is backed by equipment. So this will be equipment trust bond, and this will be mortgage-backed securities, MBS. This will be equipment trust certificate or equipment trust bond, and this will be collateral trust bond. Yeah, that's it. It's like I explained it and then marked the wrong one. All right, thank you. Let's move on. And so far, so good. If you get this, I promise you, I will have finished the question on that area. If you get this, then that will be it for the first reading. That will be it for the first reading. Good, good, good. What's the answer? Oh, you're taking time to read. If you get this, I'm telling you, and then I'm saying that this will be it. I will not even worry myself again, making it, giving you other things to worry. Just try it. Just try. Because it's a long question, I will give some time for you to try. Just try it, look at it again, read it quietly, and answer the question. Read it quietly and answer the question. ND. You know, I'm Helen ND. I'm saying ND, and then I'm Helen. So I'm saying that a bond portfolio manager is considering 3 bonds, A, B, and C. Considering 3 bonds, A, B, and C. And so the question is saying, after giving all this, is the manager most likely correct? A, B, and C. Bond A allows the issuer to call the bond before the stated maturity. So this will be a callable bond. Bond B allows the investor to put the bond back to the issuer before the stated maturity, and this will be a puttable bond. And bond C contains no embedded option. This will be option-free bond. Option-free bond, right? Option-free bond. The bonds are otherwise identical. The manager tells his assistant, bond A and bond B should have a higher nominal yield spread to a U.S. Treasury than bond C to compensate for their embedded option. This guy is correct. He would have been correct if he had said it's only bond A, right? If he had said it's only bond A. So the answer would be no. The answer would be no. Bond B, nominal yield spread should be less than bond C, correct? I said if anything favors the investor, the yield will be higher. If it favors the issuer, the yield will be higher. If it favors the investor, the yield will be lower. So the C will be in between. That's what it means. When I say higher, it's higher than the option-free bond. So the answer to this question is B. Yeah. Because I saw some of you got it correctly. Some of you got it correctly. I will. I finished the question, so we'll move on. Good questions for a review. Nice one. So, you know, I promised that that's the end. So that's the end, actually. So let's look at the second reading, issuance market. This one, I'll just go straight to the question, just be explaining some things when we get in. So this, you know, we did some of this, but then I'll allow you so that you add more to the correct answers that you have, just to give you an advantage, right? All right, you see? In fact, you know, another option that I saw is CB, I held you. So C and B is just saying, like, just choose which one is good for you. A fixed income security issued with a maturity at issuance of 9 months is most likely going to be classified. Maturity at issuance 9 months is most likely going to be classified. I don't know where this is actually coming from. It's not from me. I've been trying to remove it. I don't know where it's
okay, let me try to clear it from my end. I should be able to do that.
Thank you. All right, thank you. I've been trying. I know it's not my screen, so, and I saw it somewhere too on top. All right, thank you. Thank you, Gloria.
You're welcome.
So we continue, and then continue adding to it. 15, continue adding. What is the answer? Why is it not coming? You know, when you see a cheap one like this, just bring it out. The price of a bond issued in the US dollar by a British company and denominated in US dollar is most likely to respond to which kind of interest rate? This one, we have done it. Don't pretend as if we have not done it, or as if you know it before, sir. All right, beautiful. So it will respond to the currency of issue. It will respond to the change in the currency of issue, and the currency, because the bond is issued in USD and denominated in the US dollar, it should be responding to the USD. Thank you. Yes, just keep adding. I hope you will keep it up. What of this one now? Yeah. This one too, we've explained. So just hit it. You know, those kind of things that you want to do to show that you know it well. All right. So now I have Akindele giving me two options to select from. Okay, I will try and do that. Let's go on. Australian company that has financed a joint venture project in Singapore using a 15-year fixed rate bond paying semi-annual coupon that are denominated in Singapore dollar. The bonds par value to be paid at maturity is denominated in US dollar, right? The coupon is denominated in Singaporean dollar, par value US dollar. This is an example of a dual currency bond. A dual currency bond, yeah. This currency option bond will give you an opportunity to choose between two currency to exercise an option. Then the global bond, we define that global bond. It's a national bond, and then it's also trading internationally. All right. Now we're here. Because I say electronic platform now, you see people hitting it in another way. Because I say electronic platform, you think the previous question is a dual currency bond. Beautiful. So this is a very good example of over-the-counter transaction. In the OTC market, buy and sell orders initiated from various locations are matched through a communication network, such as a Bloomberg fixed income trading platform. The name electronic does not mean it is an exchange. Yeah. Okay. Yes. You know, in public offering, just want to do something just for those that will be following me to just understand some of these things. You know, in bond market, we have the primary bond market and we have the secondary bond market. In the primary bond market, the issuance can be done through public issue, public offering, what we call public offering, or it can be done through private placement. With private placement, you just go to private placement, you just talk to a high net worth individual and they will buy the bond. That is that. But in public offering, we have three areas that we're to look at. We have the underwritten offering. This is firm commitment, firm underwriting. In the firm commitment or firm underwriting, here the investment bank, the underwriter, is taking it up. So here, all the issues will be subscribed to. Then we have best effort. Best effort, the underwriter is just saying that I will take it, I will sell it, I will make best effort to sell it in the market. Anything that is not subscribed to will be returned to the issuer. So with firm underwriting, it is going, the whole issue is coming to the books of the underwriter. However, with best effort, what is not taken is going back to the issuer. Then we have the auction, we have auction. We have auction where they just auction, use auction to just bid. So the investors will bid for that. And then we have what we call shelf registration, where you have one big registration, a very big issue, and then you have smaller ones that you'll be doing from time to time. In terms of the secondary, so shelf is just like, I've registered plenty, I put it on the shelf, and then I will bring in it when I require. In terms of the secondary, we have OTC, over the counter, which is where most bonds are traded. and then we have the organized exchanges. So these are the two type of markets. So anything that is happening here will affect this will affect the borrower, issuer. Anything that is happening in the primary market affects the issuer. So the money goes to the issuer. But what is happening here is just among the investors. So when you hear that somebody, this is just a transaction between one investor and another, and it's happening in the secondary market. So the answer to this question, you have said the answer is in primary bond market, the method of allowing certain authorized issuers to offer additional bond to the general public by preparing a single all-encompassing offering circular is most likely referred to as shelf registration. Under a shelf registration, the issuer prepares a single all-encompassing offering circular that describes a range of future bond issuance, all under the same document, right? The master prospectus. It can be there for so many years before its replacement or updated. All right. Yes. 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 Beautiful. Which of the following product provide protection against inflation? It is we call it inflation-linked notes, and sometimes it is called linkers because it adjusts sometimes it adjusts the principal, sometimes it is the coupon, sometimes it's the coupon with the coupon and the principal that is adjusted for inflation. If the principal is adjusted for inflation, if is the principal that is adjusted for the inflation, what happens to the coupon? Will the coupon increase, and what will happen to the coupon rate? Will the coupon increase? What happened to the coupon, and what happened to the coupon rate? What happened to the coupon? You say coupon is the same. Yeah. Yes, so the coupon rate increases, coupon rate remains the same. Beautiful. So the coupon increases, coupon rate remains the same. That is the idea. All right. Let's move on. Yes, this is another one. Sorry, I think I saw a question that I missed. Someone is asking what is console. Those are perpetual. Another name for that is perpetual bond. Those are bonds that were issued with maturity, with no defined maturity. They are just, usually you will see those things will give you the option to redeem will be with the government that issued the console bond. All right. Hope I have answered. So yes, so this is a good question for you. Okay, yes. Yes, keep it coming. All right, so all right. So let's even know let's try and understand what this means. A structured finance instrument whose coupon rate is determined by this formula is most likely what? A leverage inverse floater, a deleverage inverse floater? The answer is, all right. The answer is B. The answer is B. A structured financial instrument whose coupon rate moves in the opposite direction of the reference rate is called an inverse floater, right? Yes. Now, because the coupon leverage, this is what we call the leverage. What levers the coupon? The coupon leverage is greater than 0, but lower than 1. The structured finance instrument is now said to be the leverage inverse floater. This is the leverage inverse floater. Yeah, less than 1. Less than 1, right? Is the leverage inverse floater. So in this example, you know, if the reference rate is increased, say by 100 basis points, the coupon rate would decrease by 50 basis points. A leverage floater will have a more than 1. If I have 1.5 in that place, for example, that would be a leverage floater. I think I've answered, Chinedu. I said, what will make a leverage floater? Okay, beautiful. So a leverage floater, yes. So this will be a leverage floater. All right, let's move on. You are doing well, so I will give you more questions. You know, they said the price for hard work is more work. So the price for passing this question is more questions. Go ahead. All right, let's move. We are 1 hour into the program, and so I'm going to be moving a bit faster, taking on some other questions. So let me know, because this question is just definitional. So I just want to know if you are good here, right? Correct. So the answer is step up note, and I saw that most of you answered this correctly. Step up note is the right answer. Leverage floater more than 1. So if it's less than 1 is the leverage. When it's more than 1 is leverage. Deleverage less than 1, leverage more than 1. For 1.5, for example, will be a leverage floater. All right. Okay, so let's move on. This is I want to take this part before I leave it. I want your answer to this, because it's a very good area. Or before you answer this, let me just bring in a whiteboard and then talk about this. You know, this is about repo, and you know what a repo transaction is. One party is giving the other. Is a transaction where one party promised to make a sale of a security. In return, there is another transaction or a promise to buy back that security in the future with a price that is known, and that is a repo. So with repo, I'm selling a security, and then I'm promising to buy back. Whoever is taking the cash, whoever is taking money, you know, repo is used for funding. If I'm giving out my security and taking the cash, that is I'm doing repo. The other party who is taking securities is doing reverse repo. So you do repo to finance a transaction. We have a repo rate. Repo rate, which is the price of you know, when you say a repo rate, you are looking at the transaction, the repo transaction. You have given me a security, and this repo rate is what you are going to be paying. And then you also have the repo margin. So if I say the repo margin, this is the value that you take above the amount that you are collecting. You get? That will be the repo margin, the value of the security. So if, for example, what you are collecting 100, but the security you are providing is 120, the repo margin will be this 20, and sometimes we call it the haircut. Now, the reason why I'm bringing up this is just that there are factors that affect repo margin. Some factors affect the repo margin. Some factors affect the repo rate. But the point I'm making here is that the repo, for you, for the exam, I just want to make it clear that both repo margin and repo rate will increase when the risk of the transaction is increased. Repo rate or margin will increase when the risk of the transaction is increased. So if, for example, I say the collateral quality is low, or I say the maturity is long, or I say the maturity is long, or I say the security is not special. Special just means it's not like everybody wants, you know, so when you say it's special, it's like what the market wants at that time. Or I say delivery is not required. Delivery is not required. These things, all of them, they increase the risk of the transaction, and so the repo rate will increase. The repo rate will increase. Then, if I say the collateral quality, you know, the opposite, if I say collateral quality is low, not opposite, I'm doing the same thing for maturity, doing the same thing for demand. So meaning that there's no demand for those instruments, doing the same thing for credit quality of the counterparty, credit quality counterparty. Then in this case, the repo margin will increase. Just giving a summary, but in summary, everything that I said is boiling down to this. It's just saying that both repo margin and repo rate will increase if the collateral, both repo margin and repo rate will increase if the risk of the transaction is increased. If a transaction has longer maturity, it means it has more risk. The repo rate and repo margin will increase. Repo rate, just take repo rate as the price of the transaction. Just take repo rate as the price of the transaction. Just say repo rate as the price of the transaction. And then so if I sold, I sold the security for 100. I'm going to pay it back. Maybe it's a percentage, so I'm going to pay it back with 110. Let's say that it's 10%. 10%. I collected 100, but I'm going to be paying back 110. Collected 100, paying back 110. That 10 is the price of the transaction. That is the repo price. In terms of rate, the rate will be 10%. That is the repo price. However, you know, when you are doing it, you do it per day, usually. So, but then in terms of the haircut or the repo margin, it is that excess that you have for the collateral. So the collateral, I gave you an example. I collected 100, but I gave you a collateral. You require a collateral of 120. The 20 on top, this 20 is the haircut or the repo margin. That is the margin. I'm hoping that it's clear. All right. Beautiful. So let's take that and then answer this question that we're going to have here. This question. Have we answered this? Okay, the repo margin is higher. Exactly. So we're saying the longer the length of the repurchase agreement, the higher the repo margin or the haircut. And that is what that means. The higher the risks of the transaction. In summary, anytime anything increase the risks of the transaction, the repo rate or repo margin will increase. Beautiful. Another one. Else, let me just say maybe two more, and then we are good. What's the answer? Which one will drive the repo margin lower? Yeah. All right. So look at this. We said which one will drive the repo, which of the following factors will most likely drive the repo margin lower. Which one, when I say which one will drive the repo margin lower, I mean this one is a low risk transaction. Which one will give me a low risk transaction? Low credit quality of the counterparty, high risk, lower quality of collateral, high risk, shorter supply of collateral. Yeah, this is what people want. The collateral is short. The collateral is not in abundance. So if you give me that collateral as security, I would like to have that because I can use that to do some other things. That's the way you look at these things. Are you okay? That's the way you look at these things. That is more valuable. Just look at it now. If you want to give me a collateral for the same amount, you come and you say you are giving me bags of rice. There are two things. Either you give me a bag of rice or you give me gold. So if you give me a bag of rice, even if they are the same amount, gold and bag of rice will not be of the same demand in terms of supply. So I'll prefer something that is really needed in the market that I can do some other things to it. Okay, I'll just take this question. No, let's leave this. Okay, yeah, we can. Yes. Just for you to clarify, just to make sure that you understand the difference. Yes. Yes, 23 is C. 23 is C. Yes. Beautiful. So the answer is next question. Eurobond are issued internationally outside the jurisdiction of any single country, and that is the answer. So everybody now is conversant with what a Eurobond is. So let's take this last one. What is the answer? What's the answer? It's not to the first, it's not, okay, what's the answer? Beautiful. Remember, a repo and reverse repo is depend on perspective. One party is doing repo, the other party is doing reverse repo. Whoever is taking the cash is doing repo. Whoever is taking security is doing reverse repo. These are questions that I needed to bring out so that you understand some of those terms. Let's move on quickly. Here, I'm not going to, this topic on valuation is a very important topic. And so let's just go straight to answer questions. I know it is important for you to understand the valuation. The use of a calculator will be very critical here. Make sure that you know the relationship between coupon and par. When we say, you already know that price can be, if a price is greater than par, if price is equal to par, we say it is at par. If price is greater than par, we say it's premium. If price is less than par, we say is discount. So The only way, what I'll just say about repo and reverse repo, just take it from this. What I'm saying is, in a repo, any repo transaction. So a repo transaction means that repo is a funding. I want funding. I want money. I'll do repo. I give somebody my security. With a promise, give somebody my security. He gives me cash with a promise that I'll buy that security. So I'm selling the security now with the promise that I'll buy that security in the future at a certain price that is determined. Now, if I'm doing repo, meaning I'm taking cash, the other party is doing reverse repo, meaning if you are doing reverse repo, what you want is you are going to be taking security. That is the difference. So let's look at this. I think we don't have so much time, but then I want us to just revise this. Let's take some questions. I just want to say that you need to know the relationship between coupon and the reinvestment rate, the price versus the par value, the yield to maturity, be able to value a bond using yield to maturity, be able to value a bond using spot rate, be able to value a bond using forward rate. And then remember the inverse effect, the convexity effect, the coupon effect, and the maturity effect. Inverse effect, you saw when interest rate goes up. When interest rate goes up, the price of the bond will go down. This is what we call the inverse effect. I know this is a revision, so I don't want to hammer these things so much because we have so many things to do. But then please remember, you need to use your calculator more efficiently. So wherever you can use your calculator, please do it. Yeah, I want to go straight to questions so that we just use our calculator to do these things. Let's go straight to questions so that you will be happy with each other. The current price of the bond. If you are writing this exam, you already should be able to use your calculator. 2 years remaining until maturity for this bond. The bond has a par value of 1,000 each and an annual required rate of return of 10%. The bonds make quarterly coupon payment at an annual rate of 6% and have 2 years remaining until maturity. I'm giving you just a minute. It's supposed to be 1.5 minutes. I'm giving you a minute to answer the question, and then I will answer it. Usually, you have to arrange your payment. Answer is coming already to show you that some people are not joking. IY, payment. What else do we need? Payment. We need payment. We need N. And so we are calculating current price. So PV is what we are calculating. Yes, if you use your calculator very well, payment will be 150. How do I get payment of 150? The bond makes quarterly coupon payment at the rate of 6% of the 10,000, and then you divide that by 4. IY is going to be 10 divided by 4. So for this payment, what was I saying? I say it's 6% of 10,000. You are dividing that 6% of 10,000 by 4. So that somebody will say, I'm not too clear here. That's payment. Why am I having payment twice? Then I will have my N. My N will be 2 times 4, which is 8. Feature value, so good. So I will change this to feature value. Feature value is 10,000, and I'm calculating IY. The correct answer is I'm collecting IY. So my IY is 89282.986. Yeah. All right. So that's fine. I saw that most of you got it. Maybe some are trying to get it using another time. Yes. So let's move on. C is correct. All right, let's move because we need to use calculator to do some things. I think I should do this for you as well. This one, I will just do this because I want us to use the calculator for this. So I convert. Just give me your answer, and then I will give you my own. Yeah, it's give and take. So when you do your I convert, you see, are we together? I convert. Second function, I convert. I convert is second function 2. Please don't attempt to do any valuation manually. Any valuation that you can do with a calculator, please don't do it manually. For this exam, don't do it manually. I'm repeating it so that it will be clear. Don't do any valuation question manually. You just waste your time and you don't have the time. Use your calculator. If you don't have it for now, go online and use the one online, or depending when you buy your calculator. So the nominal rate that is given, which is 10 years, 6% coupon paying bond is priced at this. The yield to maturity of the bond is semi-annual bond basis is 6.23. This is the annual rate on a semi-annual bond basis. Good, somebody has given us the figure already. So we are saying the yield to maturity, assuming a monthly periodicity. So here we said nominal using your I convert will be 6.23. You enter, then you do arrow, is it arrow up or arrow down? Second function, I convert. Yeah, you should nominal, then you do arrow up. You will see the periodicity. You see that if you do arrow up, you see the periodicity and CY. Please change the CY to 2. If you do another arrow up, you will see compute. You will see effective. Just do compute. What you are computing is the effective, and the effective will give you a figure. I think 6.32. When you have the effective at 6.32, change the effective. I will change the IY, arrow down. You have CY, change the CY to 12. Arrow down will take you to nominal, compute the nominal, and what you have is 6.15. Take a picture, keep it somewhere. Remember, so I said the first part is I convert, so second function I convert is second function 2. If you go to second function, when you are putting I convert and you see, what you see is the nominal. So when you see a nominal value, this is the stated rate, is 6.23. But this 6.23 is stated on a semi-annual bond basis. So you change it to 2 to calculate the effective. So CY to 2, and then calculate the effective. Compute. When you compute the effective, you get to 6.32 or 6.327. When you compute the effective, you will see effective. Change the effect. Do arrow down again because they want you to compare it to a periodicity of 12. So change it to 12. Enter arrow. Enter and calculate the nominal. The nominal is 6.15. You are saying that if a bond is paying 6.23 on a semi-annual bond basis, then it is similar to a bond that pays 6.15 on a monthly basis. It's 6.15 on a monthly basis. This is the effect of those discounting that comes in. Take a picture and then follow it up. Do it once and twice. Again, my people, please, I did not get the calculate method. You got it here. Second function, I say I convert is second function 2, right? I convert is second function 2. So please, anything the calculator can do for you. My own is that, I told you that at the beginning that you bought this calculator. This is a machine. Allow it to sweat. You can't buy a super engine and then you are driving like somebody who is using a Carina. Remember the Carina, or is it some of us that still remember Carina? Some of you are too young to remember Carina. Carina 2. Let's move on. This, I don't know if to do this, it will waste some time. But remember, I said we need to calculate. We should be able to calculate bond on a semi-annual bond basis, on a spot rate, using spot rate, using. I should explain the working again, so I should go back a little. Wow, and this, the video is there. The video is there for you, so that you can go back to it. I gave you the steps as they are. First, I convert, then you see nominal, enter 6.2, enter 6.2, and then arrow up, you see C over Y, change that C over Y to 2, enter the 2 at C over Y. Don't need to clear I convert. Just keep working. It will not confuse you. C over Y, it will give you 2. You put 2, enter the 2, then arrow up, you see effective. It's not effective like this, it's EFF. So let me put something so that I don't go and say this useless man wrote effective, and I can't find effective as an effective. So it's EFF. You see EFF, you see, just put in the ask this thing to compute. Compute is CPT, right? Do compute, and it will give you 6.32 whatever. Then arrow down, you see, change your CY to 12 because it's monthly periodicity, and then you are fine. Remember, we have you remember, we can move on. You can always clear your workbook, or you clear your TVM. Workbook can clear, but it doesn't matter anyway. For iConvert, it doesn't matter. The implication is less. So let's set. Somebody is saying, please, begging us, please do this question 28. Okay, I will do question 28. A 12-month spot rate is 4%. The 4-year spot rate is 6%. Which of the following is closest to the 3-year forward rate to start in 12 months? Now, here we are looking at spot rate and forward rate. Given these rates are stated on a semi-annual bond basis, the rates have to be converted into 6-monthly rate to calculate the forward rate. Before then, just to make sure that we are doing the same thing. If a 1-year spot rate is 2, 2-year spot rate is 3, and 3-year spot rate is 3 years. Okay, 1-year spot rate is 2. 1-year rate 2 years from now is 3. 1-year rate 3 years from now is 4. These are forward rates. Sorry, these are spot rates. I just want to calculate the forward rate. So these are spot rates. So this is here, this is spot. And then you are asking me to give you what is the 1-year rate. What is the 1-year rate 1 year from now? 1-year rate, if I'm here, 1 year, the rate is 2%. Then if you are asking me for 1-year rate 1 year from now, meaning for a 2-year, the rate is what? 2 year, the rate is 3%. For a 1 year, the rate is 1%, 1 year, 2 year. But what you are asking for is 1 year rate 1 year from now. So after 1 year, what is the 1 year rate? This is what we call the forward rate, 1 year rate 1 year from now. So to do this, to calibrate this very well, to do this, to give me 1 year rate 1 year from now, I will start from the end, 1.03 raised to power 2. This is the 2 year, this is the 2 year rate, raised to power 2 is equal to 1.02 raised to power 1, and then 1 plus f raised to power 1. I didn't want to start from the beginning. I would have said spot rate, a 1 year rate. That is what I'm saying. It is equivalent. This should be equivalent. Investing in 2 years direct at 3% should be equivalent to investing in 1 year at 2% and rolling it over for another 1 year at F rate. That F rate, I don't know, is what I want to find out. So to find out this, I would say this will be 1.03 raised to power 2 divided by 1.02 raised to power 1 minus 1. This will give me my F, right? A shortcut to do this is to say is 3 times 2 minus 3 times 2 minus 2 times 1. That will be the same, right? 3 times 2 is 6, and 2 times 1 is, right? Yeah. Good. 6 minus 2 is 4. So this one too is equal to 4. All right, beautiful. So this is, the F is 4%. What this means is that investing for 1 year, investing for 2 years and getting 3% is equivalent to investing for 1 year at 2% and then rolling it over for another 1 year at 4%. Now, with this I just said this background, you have this to look at any other time. You know, you can also do 2 year, you can actually do a 1 year rate 2 years from now. You can actually do a 1 year rate 2 years from now. What it means is that you are looking at the 1 year rate. I'm looking at the year 3 and year 1. What is this year? What is this rate? What is the 1 year rate? What is the 2 year rate 1 year from now? What is the 2 year rate 1 year from now? Setting this equation, I will just say again, it is 1.03 raised to power 2. Oh, sorry. This should be 1 year rate 2 years from now. That would be 3 is 4%. Raised to power 4. 4. This is 1. So year 1, year 2. So I'm here 1 year rate. 1 year rate is 1.02. But then I'm looking for 1 plus F raised and the 2 year. This is 3. So you can do the same, and then you have the answer. All right. This is just to set the equation up for you. But then what we want is this time the rate is different. So if I have this to set, I will just set it up and then so that you have something to review. We are saying 12-month spot rate is 4%. 4-year spot rate is 6%. Which of the following is closest to 3-year forward rate to start in 12 months? So if I have this, I said this is year 1. I'm saying, what is the 3-year rate? Year 1, 2, 3, 4. So 4 year is 6%. 1 year is 4%. 1 year is 4%. 4 year is 6%. I'm looking for this one rate between this 1 year and 1 year and 3 year. Sorry, between 1 year and 4 year. So here again, the same thing, I'll just set this equation for you. It is 1.03. Remember how we got 0.3 is, okay, let me just do it fully. Before somebody again say this useless man. It's actually 1 plus 6%, but the 6% is divided by 2. And then here I will have raised to power 6 because raised to power 8 because it is 4, the fourth year times 2. This is semi-annual. That is why it's going to be a little bit different from what we have done. Multiply by 1 point. I'll do 1.02, but I'll expect that you know that if I do 1.02 is because I'm using 4% divided by 2. Sometimes to avoid this 1 plus 4% divided by 2. Sometimes to avoid this confusion. Raised to power 1 times 2. This will be multiplied by 1 plus f, the forward rate. This is for 3 years. 3 times 2. This is the setup. Please, you can finalize this at your time. Is that okay? You can finalize this at your time. If you do this and you do it properly, it should be able to get, because whatever you get when you multiply, when you annualize it again, you'll be able to get 6.67. Please don't use the annualized figure. You need to annualize it to get the annual figure. Take a picture, review it at your time, and you'll be fine. Yeah. All right. With maturity, if the bond is currently priced as is, they are able to maturity. Which this is okay. Let's use our calculator. Somebody actually, wow, I'm gone. Somebody actually requested that we use calculator to do AI. So let's use it. Okay, I want to explain that sometimes the question recently issued value which will pay no coupon payment for 4 years. Regular coupon will start at 8% until maturity of the bond in 10 years. The price is priced at the average maturity. Which kind of bond is this? Just a question. Just which kind of bond is this? Just read it and tell me which type of bond. I'm not asking you to solve the question. Just tell me which kind of bond. Okay. This is deferred. So if you say 0 coupon, it is 0 coupon for only, it's for only just for 4 months, for 4 years, and then it pays coupon. So we say deferred coupon. This is a deferred coupon bond. But I just want us to do this. If I'm pricing deferred coupon bond, please, I'm going to be using the cash flow function. Okay, let's look at this. Here we have a bond. We want to use, I said when you have a calculator, make sure the calculator works for you. A bond has a settlement value, settlement date of this. The 6% semi-annual coupon payment are made on this March 30th and September 30th. In addition, the bond matures at September. This is 360. Assuming the yield to maturity is 5%, you have to calculate the full price and the flat price of the bond. Full price and the flat price of the bond. When you buy a bond in between coupon payment period, the accrued interest is part of the coupon that belongs to the seller. The accrued interest is part of the coupon that belongs to the seller. The accrued interest belongs to the seller. However, the other part, when you are buying the bond, you have to pay that accrued interest with the price to the seller. So the price that includes the accrued interest is what we call the dirty price, and the clean price or the flat price is the price that does not include the accrued interest. So the quoted price is the flat price, but then the invoice price is going to be the dirty price. So let's move on. Here, you use your calculator. Second function bond. Second function bond is 9. Now, it depends on whether you are using your calculator is American or European. What I have is the American style. It starts with the month, and then I have the date, the day. So if you're starting with the month, like this one is saying June 30th for the settlement date, that is what you have, SDT. SDT, so I will do 6.303013. I will enter. Then I will do arrow down. What I will see is coupon. And then the coupon we're giving 6%, though it's semi-annual. 6%, I will enter. Arrow down, I will see RTD. RTD is September. I will enter 9 for September. Then 30, 18. 30 is the day, 18 is the year. The calculator will recognize that and reshape it properly for you. And then RV, I will put in my RV, redemption value of 100. If I do arrow down, I have the Y, I will take 2Y. If you don't have 2Y, you have to do second function set. But I have 2Y, so I will put my own I have 2Y. If you don't have it, do second function set. Then if you do arrow down, you have your yield. For yield, we're giving yield to maturity of 5%. So yield will be 5%. Just write 5 and enter. Then if you do arrow down, you will see price. If you do arrow down, you see price, compute. Price, compute it. If you compute, it's going to give you a price of 104.558. 104.558. That's 104.558. It is this one, this 104 is the flat price. If you do arrow down, you are going to see accrued interest. And the accrued interest is 1.5. Accrued interest is 1.5. So if you want the dirty price or the full price, it will be the summation of 104.558 with 1.5, and this will be 106.06, something around that. How do you get SDT? 2Y, when you see, no, I didn't type anything. When I say if you have 2Y, you leave, otherwise you do control, you do second function enter to change. So just do when you are at that place, do second function enter, second function, enter is where you see set. Second function, and it will be giving you, if you need 2Y, but if what you have is 1 divided by Y, 1 over Y, do second function enter, and it will change to 2Y. The same, is that okay? Yeah. So SDT, I'm saying then if your date is American, because if your date is the British type, then it will give you an error will be coming to you. So start for the British, you are not starting with, you are starting with the day. So you are doing 30.613. 30.0613. Yeah, okay. I hope it's clear. Take a picture. You have the steps. Just keep trying, and then you master it. But please don't use formula to calculate it. Now, I want us to extend a little bit because no time might not be our friend in a while. So I want us to do something. They say my writing is not clear. Because you didn't follow me when I was writing it, because I was saying it when I was writing it. So I'm saying that first you do second function bond, and then you get what you see is SDT. When you see SDT, type in 6 representing the month, it is June, and dot. Then you do 30, 30 is the day, and 13 is the year. 30, 13, and enter. Then arrow down, you see coupon. Put 6 and enter, and then arrow down, you see RTD. RTD is the redemption date. We're giving redemption date as September 30, 2018. Put in the September. Put in the September and then arrow down. Put in the September 9/30/18 and then arrow down. And then, 9/30/18, enter. Then you see RV, redemption period, redemption value, 100, arrow down. Then you see 2 over Y. If your own is 1 over Y, I said, do second function set. Do second function, enter. Or second function set, and you do change it. And then you see price, compute, and then you get a price of 104.558. I'm saying that is the flat price. You see arrow down, you see accrued interest equals to 1.5. I'm saying this is the accrued interest. To get the flat price, you need to add the accrued interest to the flat price. Now let me continue. I'm going to say it quickly. In case time, usually time will do it. I know it will do it. It has always been doing it, and it will do it this time around too. So just make sure, let me just go a little bit lower. Just arrow down. If you continue going down, you see duration. You see duration. I know we are not there, but I just want to give you a hint so that even if we don't do it that place, you know how to do it yourself. You see duration. When you see duration, this is the duration of the bond. This is the duration of the bond. However, this duration that this bond is giving you is called modified duration. If the calculation is saying I should calculate Macaulay duration, I will just take the duration, the modified duration that I'm given by the calculator. I will multiply by 1 over R. The R will be divided by the periodicity. This is how I will get my modified duration. So I'm saying that the modified duration will give it to you. All right. We don't have time again, so I'm going to move, and then I'll move quickly. I will move quickly so that you have that. So this is still the same thing, but we have done it. So we just leave this example for you. Take a picture and try it and make sure you have 2.667. Let's move on. Let's move on. Remaining life of the bond. What is most likely to occur to the price of the bond between today and the maturity? What's the answer to this? It is a simple question that does not require calculation. All right. Do I just leave it for you? Yeah, beautiful. So the first part to know is that this bond that you are looking at, if the discount rate is increased, discount rate increases 7.5 from 6.5. 7% coupon paid annually, 5-year at a discount rate of 6.5. Coupon 7, you already know that is a discount bond. The value of the bond is 102. The value of the bond is, sorry, is 7% coupon. 6.5 is a premium bond. So this is the value of the premium bond. 1 day later, the discount rate increases. So the price of the bond will go down. It increases to 7.5, coupon 7. It means it's now becoming a discount bond, 7. It's now a discount bond. So at that point, the price will go down because interest rate has increased. So price will decrease. Assuming the discount rate remains at 7.5 over the remaining period, what is most likely to occur to the price of the bond between today and maturity? The price of the bond will decrease at the beginning, but then it will increase later because a discount bond will have to be increasing in value as it approaches maturity. Yes, the discount bond will increase in value as it approaches maturity. At the beginning, it was a premium bond. Then there's a change in price. The interest rate went up, price went down. The bond now is a discount bond, and as a discount bond, the price of the bond will increase until it reaches maturity. It reaches par at maturity. So many questions. Because somebody asks, we just have some few minutes. I just want to move to the reading on duration to just say some few things. For you always have our numbers. You can always call us. You can send text. You can chat us to give clarification. So many questions to cover, but the time is not a good friend in this regard. So I'm just showing you so that you appreciate the fact that we have so many things to look at. We're not going to be. Yes, so I will just move quickly to the to the reading here and just talk about it in 5 minutes, and then I will leave the rest. I already showed you how to calculate Macaulay duration. Just if I have this. If the question is asking me to calculate Macaulay duration like this, we can use that our calculator to calculate the Macaulay duration. I just want to emphasize that one part of the reading that is very important and significant. Sorry, I know the time is it's up. I just want to make some few points on duration. Okay, that's okay. Okay, I think I'm having a good, okay. So for Macaulay duration, I got the question on Macaulay duration to just remind you on how to solve the Macaulay duration. You saw those steps that we followed. Sometimes even if they don't give you the particular date, just make your assumption. If they say it's 10 years, I will just say 2000 to 210. That will be a 10-year bond. So I will just do that to get the thing. Multiply, just calculate the duration. Do that same thing that we did in the calculator to get the duration. Enter it into the calculator that same way. That same way we did to get the accrued interest. Put it in the calculator, get your accrued interest. Arrow down will give you the duration of the bond. I'm just saying that the duration you got is modified duration. So to change this modified duration to Macaulay duration, you need to change it to Macaulay duration, you need to multiply that modified duration by 1 plus the yield. the yield needs to be divided by the periodicity. So if it's semi-annual, you divide by 2. If it is annual, you divide by, you don't need to do any division. And this will give you the Macaulay duration. I think I will just, there are good questions. They say I should roll, I should just roll so that even if they are not here, you will be able to answer the questions. There are good questions to look at before you enter your fixed income exam. Yemi, am I up, or I still have some 2 minutes? Let me just.
Hi, Musa, your class finishes at 4:30, so, and this is 4:21, so I think you have some time to round off. Okay.
So in that case, I want to just make some good points, generally on duration and the different duration measures. So Macaulay duration is the duration. When we say Macaulay duration, this is a duration measure that gives us duration in terms of time. So it is the weighted average of the time it takes to recoup or to get back the cash flows of a bond. And that duration measure gives us the duration in time. And so in that case, it's not giving us that sensitivity. You know, duration, we say, is a measure of the sensitivity of a bond's price to the change in yield. The Macaulay duration is just more important in the determination. Now, what we use Macaulay duration mostly is in the determination of what we call the duration gap. The duration gap is just the difference between Macaulay duration and investment horizon. If the Macaulay duration is greater than the investment horizon, the duration gap will be positive. If Macaulay duration is greater than the investment horizon, how long you want to hold the bond for, the duration gap is positive. And if you face a positive duration gap, the risk that is of your concern to you is the price risk. Price risk is the risk of interest rate going up. This is the risk that is faced by a short-term investor. This is a very important summary I'm doing here so that you just understand it. If my Macaulay duration is less than my investment horizon, Macaulay duration greater than investment horizon just means that at the end of the investment horizon, you need to sell the bond. And so because you are going to be selling the bond, the price change will affect your bond, the price of your bond. You might be selling the bond at a loss. So interest rate going up is a risk to you. And this is a risk that is faced by a short-term investor. The Macaulay duration less than the investment horizon means that I have a negative duration gap. A negative duration gap, the negative duration gap is a risk of interest rate going down. This risk is that of reinvestment, meaning that you are facing an reinvestment risk. If interest rate goes down, you will be reinvesting the bond at a loss, at a lower rate. And this is the risk of a long-term investor, meaning that I'm supposed to hold the bond to my investment horizon, but this bond has a life that is shorter than my investment horizon, meaning that they will give me the principal. I'll have to be reinvesting it to get the realized return at the end. An investor with investment horizon of 6 years buys a bond with modified duration of 6. So investment horizon is 6, but please don't use the modified duration as given. You need to convert this modified duration to a Macaulay duration. So to convert, it is modified duration divided by 1 plus yield to maturity, right? So this is what you use to convert Macaulay duration, to convert modified duration to Macaulay duration. So this is what you are going to use to determine the duration gap. And in this case, the duration gap will be positive because of what you are going to be getting. Macaulay duration will be higher than the investment horizon. So, and then another thing, very quickly, another thing you need to also understand is that the duration, effective duration, modified duration gives you a price change. It's a linear measure that gives you a price change for a 1% change in interest rate. So if interest rate increase by 1%, what happens to the price of the bond? That linear measure is assuming that the price increase and decrease is the same for the same increase in interest rate. It is not modified duration is a good duration measure, especially when you have bonds with embedded option. So if a bond has an embedded option, the best duration measure to use is the effective duration. When you have a callable bond or a puttable bond, please use effective. Now the truth is that effective duration can work for all bonds. However, effective duration can be used for all the other bonds. However, as long as a bond has an embedded option, the only thing you use is effective duration. You can't use any of these other duration measures. So quickly. The only bond that has a negative convexity, for your level is the only bond that has a negative convexity is the callable bond, right? Is a callable bond. So when you have a question asking you which one has a negative convexity, even a puttable bond will not have negative convexity. Duration of a portfolio is a weighted average of the duration of the individual securities in the bond. So the weight, make sure even if they give you a nominal rate, the weight that you use is going to be the market rate. Gentlemen and ladies and gentlemen, I know you have so many questions to ask because so many things to do. Our work is to really make it easy for you to understand these things. Please send your questions anytime and we'll give you some clarification when it's needed. All right. So some question on this side, not too difficult, but also good to look at. Thank you. And I expect that if you have questions, I will answer. It.
Thank you so much, sir.
Yeah, thank you.
Okay, and I guess you'll be sharing your slides with the candidates. That's fine with you, right?
You will be sharing my slide with the candidates.
Yes, also, through me, yes. Through me.
And also what I will do is to give them my number in case they want to ask some questions. And then also give them the slide. Please don't give them the PDF. Don't share the
PowerPoint.
PowerPoint, share the PDF so that it will not be touched. And then if there are anything, they know how to get to us. LinkedIn, anywhere, social media, anyone, they can always get to us to give some clarification.
Okay, awesome. Thank you very much.
And thank you, everyone, and thank you all for being part of this. We appreciate every one of you. Thank you. God bless you.
Thank you.
I wish you the very best in the exam. Yes. I'm off.
Question from Victoria. Which platform do one complete the event survey? Okay, at the end of this bootcamp, we are going to send an email to everyone registered to attend. If you registered, we have your email address. So we are going to send out an email with a feedback survey included in that email. So once you submit the survey, it's a very short survey, like 3 questions. Once you complete it, you'll see a link to download all the slides that was used in the bootcamp from yesterday till today. We just put everything in one folder for you. So coming up next is corporate issuers. That will be facilitated by Mokwe Lola Jato. Hi Mokwe, can you share your screen and
hi everyone. Thank you, Musa. Yes, I sure can.
Right.
Okay.
Thank you, Mokwe. Sorry, I forgot I'm supposed to introduce you.
It's fine. You are forgiven. I was also learning. I was also learning from the fixed income class.
Sorry about that. Thanks.
No, it's fine.
Good afternoon, everyone. I am so sorry. Unlike Musa, I will not be able to share my face because for reasons you don't want to know. But yes, I will not be sharing my face. I will not be sharing my. I will not be sharing my. You can only see my screen. Let me put it that way. Well done, guys. This is. I'm going to take an hour. Hold on 1 minute. I'm trying to put it on slideshow so that we can just take off. Okay. So because I can't show my face, I have put a picture of what I look like for you. I see some people that I know. Hi, Chinwe. Hi, Gloria. Some of you that I know. We're going to do this in 1 hour. That's the plan. The goal is to finish all of the topics in corporate issues in 1 hour. It's a lot. About 8 readings. I make up about 8 to 12% of the exam weight. The plan is to touch on all the things that are important and then leave about 10 minutes, give or take. It's a tall order. It's a very ambitious order to finish all of these things. My approach is not to do questions. It's just to touch on major things so that when you start to see questions or when you attempt your questions, for those writing in May, I imagine you're already doing questions. So let's just get to it. These are all of the topics, and I'll touch on each and every one of them. One of the things that is important for corporate issuers is the fact that some basic things in corporate issuers also feed into other topics in your curriculum. For example, time value of money feeds into how you do your DDM and all of those things. So when it says 8 to 12% of your exam, I'm sure it's because it enters into other readings in the curriculum. So these are study sessions 9 and 10, readings 28 to 35. So let's get to it. The first topic is corporate structure and ownership. Please drop your questions in the chat box. It's okay to unmute and ask questions. I'm not sure how it works, but you can ask a few questions. Because I talk really fast, please stop me and ask your questions as we go ahead. Again, if I just need to be sure, I hope I'm not talking to myself. Can everybody hear me?
Yes, Mokwe, I can hear you. So just a quick one on unmuting. The attendees are not able to unmute themselves because we are trying to manage time. So we usually encourage them to drop their questions in the chat box.
Okay.
So you will see a lot of messages in the chat box as you are progressing. Thank you.
Okay, fantastic. I'll try to manage both. I don't know if I'm good at that, but I'll try to manage both. Okay.
If I need to draw your attention, I will. Yeah.
Okay, yes. Thank you so much. That would be helpful. Okay, we're starting with the first reading, and it just talks about the different structures of ownership in business. And really, what does that speak to? I think the focus is, what is your liability? What does liability mean in this is there limited or unlimited liability? And what is the legal relationship between the owner of the business and the business itself? The first type is sole proprietorship, and is the simplest and easy one, where the business is the same thing as the owner. Liability is unlimited. And in the business sense, when we say unlimited liability, it means that if the business runs into trouble, legally, your personal belongings can be taken to take care of your debt or whatever you're owing, can be taken to take care of your liability. That's what it means. So when we say we have limited liability, it means that no matter how much trouble the business runs into, your personal holdings or your personal business or your personal things cannot be taken to take care of what you're owing in terms of what the business is owing. The second part is general partnership, and that's a place whereby we have two owners. It's still very similar to sole proprietorship. The only difference is there's still more than one person here. And the same thing, there's a limited liability, and the profits of the business is taxed just like personal income. Then we have limited partnership, where we have a general partner and a limited partner. General partner is the one who, their only claim to the business is what they have put into the business, and their only liability is also what they've put into the business. Sorry, that's a limited partner. Then the general partner is the one who runs the business and has unlimited liability in the business. The biggest type is a corporation, which the legal entity is different from a business by itself. That means the owners of the business are not the same as the business. The business itself is a person, and that's what I mean by legal entity. And it means that if there's trouble, the owners of the business are only responsible to the level of what they've invested in the business. Pardon me, please, my slide is not moving. Okay, moving on. How can a company become public or private? Most of these companies I have talked about now, they're either private or public, but most of proprietorship businesses are private businesses. A company can become private by issuing an IPO, carrying out a direct listing of its stock, or by being acquired by another company, and the company can also go private through a leveraged buyout. A leveraged buyout is when a group of people come together, take some form of loan or what have you, and buy the organization, the organization over. Management buyout is when the management of the organization come together to buy the business. Also, I mean, organizations can sell their shares to high net worth individuals. I can have a business now and say, let's say this is McQueen Incorporated, and I know that Musa is capable of buying my business over. I can just go ahead and sell my business to Musa because they can afford it, and then it has become private. One of the things that really distinguishes public and private organizations is the disclosure requirement. Private organizations are not required to disclose how their business are run, and are not required to do anything periodically, but public organizations have a requirement to do so. Also, in terms of claims of lenders and owners, when it comes to a business, the lenders have the highest priority to claims of a business. This is what I mean. I mean, if a business is going down or if there's an issue, who has the first priority is the lenders. But that, just as they have the first priority, they also have limited potential if the business does well. What that means is that no matter how well a business does, the lender is limited to the interest and the debt and the principal that they give. But the owners of the business have unlimited potential, meaning that there's no limit to how well the business can do when it comes to them. But remember, that also means that for them, when the business is going down, they have last priority. That is it for the first reading. Moving on to the second reading. I hope I'm not too fast. Clara, is there any question for me on that before we go into corporate governance and ESG corporate
no questions so far. No questions so far.
Okay, so that's it for the first reading. Second reading is ESG, Introduction to Corporate Governance and ESG Considerations. Before now, it used to be that when people are investing, all that matters is maximizing your return based on a limited, based on and minimizing your risk. But we're saying that going forward now, there are a lot of things that have started being important. Things like what is my moral? What do I take important? What is important to me as an organization? What is important to me as a person? Are there things that I'm thinking, okay, much more than money, much more than a return on my investment, this is even more important to me. So this is where this comes into play. So this reading is kind of divided into two. The first part talks about corporate governance, and the other part speaks to ESG issues. And corporate governance really just refers to internal controls and procedures for managing an organization such that all of the stakeholders are being taken care of. There are two theories there. There's a shareholder theory that focuses just on shareholders. And what is it for shareholders? Maximizing their value, maximizing their return on investment. There's another broader theory which is a stakeholder theory, that takes into consideration the broader group of stakeholders. In a business, generally, the groups of stakeholders that we have are, first of all, the shareholders, the board of directors, employees, suppliers, creditors, etc. Now, because there are different groups of shareholders, it's only normal that conflicts of interest will arise. And why is that? It's arising because of the principal agent conflicts. The principal here are the shareholders, are the owners of the business. The agents are the people that they have recruited to take care of their business for them. But a lot of times our interests don't always align. And because our interests don't align, everybody, natural human nature, will do what aligns most with their interests. So this is why this conflicts arise. It also arises because there's information asymmetry, and that arises because, in a business, the people running the business will naturally have more information. It's just like, think about it. Even when you own just a shop and you have a shop girl taking care of your shop for you, they have more information than you if you don't go there every day. What will be, for example, the shareholders want to maximize value, want over the years and in the long term, for the return on investment to be higher. For a creditor, for example, what do I want? I just want you to be able to pay my money back, the money that you have taken from me, which means that naturally I would not want you to take on risks. For a business owner, shareholders in this sense now, it might be that taking more risk is what's going to grow the business value over time. So that's what I mean when I talk about conflicts of interest. The types of conflicts that we have examples between the different groups of shareholders. We have different categories of shareholders. We have some who, for example, they're going to exit their investment so soon. They don't even want to dilute their ownership. They don't want anything that will affect the value when they're exiting. There are people who are there for the long run, and that their own goal will obviously automatically be different from those who their goal is for the short term. We also have conflict between creditors and shareholders. I've spoken to that. And then conflicts also arise between shareholders and other categories of shareholders. Speaking about these conflicts, how do we manage them? Between the stakeholders, the shareholders, the way to manage it is generally through annual general meetings. These meetings are held once a year to take care of normal ordinary resolutions like approval of committees, election of the board members and what have you. But there are also times where extraordinary meetings have to be called to decide on special resolutions. And special resolutions will usually require supermajority of votes. Supermajority would mean 2/3 or 2/3 or 3/4 of all the shareholders. If a shareholder is not able to attend the meeting, what they will do is appoint somebody to vote, appoint a proxy to vote for them. We also have a group of activist shareholders. These are the ones that pressure organizations to make decisions they think are best for shareholder value. The question is it best for shareholder value or is it just best for them? There's also something called proxy fight, where a group of shareholders come together to fight a decision that has been made on the board. All of these speak to shareholder mechanisms in managing shareholder relationships, shareholder mechanisms. Now, speaking to other stakeholder relationships, so what shareholders would do would be to appoint board members to take care of their needs, to take decisions for them. In doing this, there are different committees that take on different decisions. Their names really do explain what they do, and I'll just run over them very quickly. Audit committee that takes care of internal controls, governance committee for taking care of corporate governance issues and codes, nomination committee proposes qualified candidates for elections of the board, compensation committee that talks about compensation for senior managers and even employees, and then risk committee that ensures that the organization is sticking to the risk appetite and the risk goal of the organization. Why is corporate governance important? It's important because when you have corporate governance issues, it starts to affect you legally. You see organizations that have closed down, not because they're making profit, but because they have run into some legal complications, and their reputation starts to be damaged. And that also speaks to the benefits of having good corporate governance. Effective governance implies effective control and monitoring, and a strong system of control and compliance with laws and regulations avoid many legal and regulatory risks. Now, that is the first part of this reading. The second part is speaking to ESG, and is speaking to other considerations apart from profit in making investment decisions. And what are the ways you can start to look at that? Number one is responsible investing. It's a broad term for considering ESG factors. What are ESG factors? It talks about things like sustainability. For example, the organization where I work for, there are decisions we have made that affect sustainability. Really, a lot of people say, what is sustainability? Sustainability just speaks to doing things in such a way that secures our future. We've all heard of global warming, we've heard of carbon emission and how it's affecting us. We might not see how those things are affecting us now, but we're saying that in making our investment decisions, we've started taking things into consideration that have positive impact on those things that I've just talked about. So there's also something called social responsible investing. Some people will tell you that they don't invest in organizations because those organizations, they do things that affect things like cancer. For example, a lot of Muslims will invest in anything that has to do with tobacco and alcohol. Some people will say they don't want to have anything to organizations that have been linked to child abuse. And child abuse in this case will be, for example, using child soldiers, using underage people for employment and what have you. And this is what ESG really speaks to. But there are different ways and approaches to taking ESG into your portfolio management. Negative screening will mean taking out or taking an active step towards ensuring that your investments don't have anything to do with certain types of companies, like taking them out. And positive screening will be the opposite. It means identifying companies that have positive ESG scores. Now, there's something called ESG scores, where organizations, you can check what an organization's ESG score is. And so this will speak to things like saying, if an organization doesn't score above a certain level, I'm not going to invest with them. Full integration refers to including ESG factors or scores in traditional fundamental analysis. We all know what fundamental analysis is. It's things like what are your ratios, what are your coverage ratios, and all of those things. But we're saying that aside that, we're also bringing your ESG scores into what determines my decision to invest with you. Thematic investing refers to investing in sectors or companies in an attempt to promote specific ESG related goals. Engagement and active ownership, investing refers to using ownership of company shares or other securities as a platform to promote improved ESG practices. For example, in the organization that I work for every event that I organize, I must say something to educate my crowd about ESG factors, things like that. Also, when you see organizations saying staff should work from home, it's because they're trying to reduce the amounts of carbon emission. In the UK, for example, I know that if you drive if your car still uses petrol, or if you're using depending on number of miles that you cover, the amounts of money that you pay, all of this speaks to reducing the carbon emission from your car. And then green bonds are securities issued to raise funds for the project with a positive environmental impact. That is all for ESG corporate considerations and corporate governance issues. Are there any questions, or should I move on to business models and risks? Okay, I take it there are no questions. Business?
No questions. Okay. Yeah.
No questions. Okay, I hope I'm not moving too fast. Business models and risk. What is a business model? Business model is really, how do you run your business? If you ask me now, oh, I produce fans, I should be able to tell you my process of what it takes me to produce the fans, what my target customer is, what my value chain and my supply chain is. That's really what a business model is. Speaking to business model, there are different pricing strategies, value-based pricing strategy. This has to do with your pricing being dependent on the value that you place on your good. And the easiest way to make reference to this would be designer items. I always ask a question, why is a Gucci bag more expensive than a Zara bag? If you ask me, you still use it to carry your things, they're all leather. But it really speaks to what value you or the customer places on the item. The other one is cost-based pricing. This is also quite intuitive. It doesn't make sense to sell something less than what it has cost you to produce it. So your pricing is really based on the cost of production. Price discrimination refers to the ability to charge different prices to different customers. And what does this mean? I always say one thing: if I go to the supermarket to buy something, the price I'm buying is different from the price I'm going to buy if I went down to the market. What are my reasons for going to the market? The reason you're able to discriminate is because you're able to segment your market. The people who will never go to the market to buy just because it's not convenient for them or they don't have time. And that's why you now see all these consumer shoppers, you see Price Pally and the rest of them, they're able to bring to your doorstep what you go to the market to buy. The reason they're able to get away with those prices is because people are able to place that value on whether or not they want to do this or do that for something else, for some form of inconvenience in terms of price. Under price discrimination, there's something called dynamic pricing. You find out that, for example, they tell you that if you want to buy a ticket to the UK or to outside the country, you should check at a particular time. Or that if you're going for summer, buy it early, because once you start to reach May, June, prices are a lot more expensive. You also see things like tiered pricing. I'm aware that in America, for example, every Tuesday or every Thursday in some shops, if you're above the age of 50, you get a 10% discount on anything you buy in some shops. And the other pricing models like bundling, which is where you sell one item, but there's so many other things that come with it. I'll give an example. Recently, I bought a Nintendo game, and by the time I ordered it, I thought it was just, okay, buy your game and buy your cartridge for my kids. But by the time the game arrived, I realized that we needed extra control pad. We needed memory card. We needed so many other things for the game to work. So the game itself might not be that expensive, but over time, the things that need to come with the game to make the game functional to me become more expensive. So they've bonded it all together in such a way that for something to function well, other things have to be bought. So you might be able to pull your customer close by bonding it all together in such a way that one item might not be so expensive or might not give you the profit that you're looking for. But by the time your customers buy so many other things that come with those things and make it more functional, and it will be better. Another example is the DSTV that we use in Nigeria. Your subscription fee is one thing that you pay, but for you to be able to enjoy your DSTV well, there's that internet that the only way you can connect to the internet is buying the DSTV router, not the normal router that you use in your house. That's another example. We also have razor and blades selling pricing style, which is selling a piece of equipment for a low price and profiting by selling a consumable used with it for a higher price. We also have optional products is another pricing model, and it has to do with having add-ons that you can profit from apart from the product itself that you're selling. One pricing model is also penetration pricing. A good example, people will say Netflix. When Netflix started, it was okay to share. There were so many things that were very lax, but these days they brought so many other things on top, such that now it's a lot more expensive to have Netflix. But in the beginning, they penetrated by the market by making it easy and cheap for everybody to come on top on board. There's also something called premium pricing. I don't know if you guys are aware, there was a time that SIM cards were cheap, were free in Nigeria. So the SIM card itself is nothing. Just like the cost of buying your SIM card for your internet or for your router is nothing, but the amount that you eventually pay monthly for your subscription is where the money really is. There's also something called hidden revenue, such as you offer online content for free, but there are other ways of generating money. I think a good example here will be our bloggers. When we go on board, when we view them, it's for free for viewing them, but we have to pay subscription for viewing them. They also charge some other people for advertisement, and the advertisement value is based on how many click-throughs, how many people are following their pages, how many followers they have on their pages. But how did they get that follower? By giving us free content and other things that makes us keep coming back to their pages. The other pricing models, right.
Hi, Mokwe. There was a question in the chat box. I got thrown out by network, so I've lost it. But if you check, I'm sure you can see it from your end. Hi, Mokwe. Can you hear me?
Oh my, I'm sorry, I'm on mute. I was talking. I apologize. I was talking. So I was speaking to the question that the person asked around, can you claim ESG consideration for making your staff work from home? And I said that the answer would be around what was the reason in the first place. Like in my own organization, it was communicated. There are two things. One is staff welfare and the other is ESG consideration. And even though it's beyond the scope of this reading, there are different ways to score companies based on ESG considerations. So if they're able to, I'll explain it, prove it, and are able to ascertain their ESG score based on whether they're allowing staff work from home, I guess it's something they'll be able to claim. I hope that answers your question. That was for Moshood Ajala. Okay, going on. If you guys can still hear me, can somebody please indicate? Chinwe said we lost her. I don't know if that was me or somebody else.
That was when you were muted. I can hear you now.
Okay, Chidi says he can hear me. Okay, Chinwe. Okay, thank you so much. Other pricing models are alternatives to outright purchasing, like subscriptions, fractional ownership. I don't know if you're aware, especially for those in Lagos, I know there are places now where we don't have that in Abuja. By the way, I'm in Abuja. At the time, my friend had told me about some form of ownership last year where you can own a fraction of an Airbnb, and then we can share returns based on maybe you own it for a certain time in the year, or we own it all through the year together, and then we share profits. External environment and financing needs. And this speaks to risk. A firm's overall risk and therefore its cost of debt and equity capital depends on its business model as well as firm specific external and risk factors. What will be your external factors? These are things outside your control but still affect your business. A good one would be business cycle, economic conditions, demographics, regulations, and political and legal environment. There are also internal things that affect you as a business, and those factors include what was your life cycle as a business, and that means what life cycle of your business are you in? Are you at the beginning? Are you at the later stage? Those things affect your risk as a business. There are also macro risks that affect not just you, but every business in that industry together. And the main macro risk for many companies are economic slowdown. We know that when the economic, and this speaks to business cycle, when there's a slowdown, it starts to affect your ability to get capital, it starts to affect your sales, it starts to affect everything around your business. Those things you don't have control over, but there are macro factors that affect every business. Business risk refers to things that affect your variability in earnings. What will affect your variability in earnings? Your sales. If your sales go up and down, it affects what comes back to you in terms of earnings. Industry risk factors include cyclicality, a concentration and competitive intensity, dynamics within your value chain, growth and demand expectations, and regulatory risks. There are also firm-specific risks that are peculiar to your own organization, such as erosion of competitive advantage. I think that organizations who are generally more competitive or who are in more competitive industries are more affected by things like this. There's also product market risk, such as changes in consumer taste, capital investments risk, such as acquisitions that did not produce returns above the firm's cost of capital. We'll talk about this under capital investment. That's it for business model and risks broadly. Moving on to capital investments. Do we have more questions? Okay, checking now, I see one. The difference between value chain and supply chain. Value chain are all those things that are important in coming to your business. For example, let's say that I'm a burger producer. What would be my value chain? The person, my bread supplier is in my value chain because it speaks to the quality of bread that I'm using to produce my burger. It speaks to how my bread gets to me. For example, if I have just one bread supplier and the quality is what makes me going back to that person, if anything happens to that bread supplier, not that I can get bread from other people, but I might not be able to get that quality of bread or at the time. If my business is such that I'd rather get my bread 2 minutes before I put my cheese inside it, that speaks to value chain. Supply chain speaks to from when I produce my bread and when it gets to the final owner, all the people involved in the link, they're my supply chain. And it speaks to, for example, am I using Jumia Food? Am I using my bike? Am I using organizations where they take bulk supply from they demand bulk and then it goes to the dispatch rider who takes to the company and then eventually delivers to somebody. It is very similar. And I remember there's a question in Shweza around it, but I think the difference is that know that your supply chain speaks to how from your input to your output and how it gets to the final consumer in your good. Value chain speaks to those things that are specific, that makes your business different, that are so important to your business, that stands your business out. I don't know if that answers the question. Moving on to capital investments so that we don't take so much time. Capital investments just basically speaks to what are those investments you need to do to keep your business either going or to expand your business. And then they're divided, there are two main categories: the business maintenance investments and their growth investments. And on this slide, the first two speak to maintenance investments because these are just things you absolutely need to do to keep your business going concern projects or regulatory or compliance projects. Regulatory and compliance projects are things that have been mandated by the government that you should do, that can put your business at risk if you don't do them. Going concern projects are ones that you're taking on either to reduce cost or to just improve your efficiency. Now, growth projects are expansion projects to grow your business, and usually they would involve a lot more complex analysis. And the other projects like new investments outside what you already do. Now, because we don't have unlimited capital, we have to allocate our capital in such a way that brings us the highest return, given the constraints where we have on limited capital. And that this brings us to allocating our capital. We need to allocate our capital in such a way to maximize our value. And in the process of allocating capital, there are 4 steps to it. Number 1 is generating your idea. After you have generated your idea, you analyze all the projects that you have, and then you create your capital budget. And after you've done that, take on the project and monitor the decisions they have made and do a post audit. And that brings us to the question of how do you create your budget, and then what determines whether you take on a project or not. 1 minute, my slide is, yeah. Okay, and you ask questions around what determines whether you take a project or not, and also what are the principles you take into consideration when allocating your capital. In allocating your capital, there's something called sunk cost. And a good example would be research that you have done around the project. The question is, should you, when you finally decide to take on a project, should it be added when calculating the returns on a project? The answer is no. There's also something called externalities, which affect your project. They're not directly involved in the project, but they affect your project. A good example is cannibalization. Cannibalization speaks to what happens, the effect on your returns or your sales when you have introduced a new type of project. For example, if I only used to sell boo-boo, and now I started saying that, you know what, I'm also going to start taking into consideration office clothing. If I'm calculating my total returns on taking on that project of office clothing, I need to take into consideration, did my sale in my area of boo-boo reduce? Another good and very common example is diet version. When organizations introduce diet versions of a product that they have, in taking into consideration whether that new product is profitable, they need to take into consideration whether or not sales of that diet version, of the old version has gone down, because if you're not taking that into consideration, it means there'll be some sort of double counting. Another thing to take into consideration is cash flows based on opportunity cost, which are costs or profits that you forego by taking on a project. And the question is whether or not they should be taken into consideration when considering a new project. The answer is yes, they should be. Another thing that is very important is the timing of your cash flows. When you're going into a project, the 5,000 naira that I receive, if I'm going into a project today, a new project, if I'm going to receive 5,000 naira today, it just might be worth more than 10,000 naira that I'll receive in December. Because that 5,000 naira, there's time value of money involved in it. I might be able to invest it so that before that December, I might be able to get more than 10,000. It might also be that when I get that money, I might be able to quickly take another project on that'll give me even more returns. So timing is important when you're looking at projects. Another thing that is important is that cash flow should be analyzed on an after-tax basis. You might be taking into consideration 2 projects. One might be higher before tax. But if it's a project, for example, in an industry or in an area that is highly taxed, it might be better for you to take on a project that has lower returns, but because the after-tax return is higher than the other one. Financing costs are reflected in the required rate of return on the project, not the incremental cash flows. What will be the required rate of return? It will be something that has been decided before time. A lot of times it can be WACC, it can be a hurdle rate that has been decided based on the particular level of risk that that project involves. When you're talking about project cash flows, there's something called conventional cash flows and an unconventional cash flow. And the only difference is that the conventional cash flow is one in which the sign in your cash flows change only once. And that means the typical type. The typical type of cash flows is one where you have an outlay at the beginning, an outflow at the beginning, and then over a period of time, you start to have inflows. You compare your outflow to your inflow to see whether or not you have value. But we also have unconventional types where a project might involve you spending money at the beginning, maybe a major outflow, and then over the course of the project, you might have to spend another time. This means that the sign for your cash flows will change more than once. A lot of people ask me this question around if you have uneven cash flow, is that unconventional cash flow? No, uneven cash flow is not unconventional cash flow. Unconventional cash flow only speaks to the fact that the sign in your cash flow changes more than once. I'm seeing a question in the chat box. Okay, sorry, it wasn't a question. It was just somebody saying thank you. Now, again, speaking to the fact that we have limited capital, and some projects are mutually exclusive. Mutual exclusivity speaks to the fact that there are some projects where you can't take the two on at the same time. Taking one will mean not taking another. It means that in making a decision on whether to take a project, there are things you have to put into consideration. And that's when we start to talk about what is the NPV and what is IRR, and then project sequencing. Project sequencing speaks to taking a project in a certain order such that it might give room for you to take another project, or it might mean that for you to be able to take on this particular project, you must have already taken on something else. Now, because we're really in business to do what to maximize shareholder value, NPV is usually a good consideration when making a decision about a capital project. NPV speaks directly to improving shareholder value, which means that all projects that have a positive NPV have adding some sort of value to the shareholders. Now, what is NPV? NPV is the value that comes to you, like in lay term. The technical part, I'll speak to it, but it's really the value that comes to you after you have invested in the project. It is your cash outflow minus your inflows. Remember, your inflows are going to come in over a period of time. So you're going to discount those inflows based on some sort of interest. And NPV is that value that you get after minusing your inflow from all of your outflows. The value that you have is your NPV. So generally, the formula for NPV is cash flow. Now, this cash flow here has a minus sign before it. So that's why it's cash flow plus. But when you take into consideration that there's a minus sign before the cash flow, it's really your inflows minus your outflow. One of the reasons NPV is very important is what I've already spoken to. It has direct impact on shareholder value. Your NPV, any NPV that is positive, has a direct impact on the value of your shareholders. But the question is, how much value does it have? So a key advantage is the fact that, okay, yes, it's directly related to shareholder value. But the disadvantage is that it doesn't matter whether the value it has is 0.001 or the value is 10% to shareholder value. Do you understand? That's one disadvantage that using NPV as a deciding factor has. Now, in theory, we say that because NPV relates directly to shareholder value, it should affect share price. But in reality, share price is more closely related to expected future earnings of an organization. So I'm saying that in terms of concepts, if you're asked what has more value on shareholder price, in theory, it should be NPV, but in reality, it's really the expected future earnings. That brings us to another point in deciding whether or not to take on an investment. How are flotation costs considered? It's in another part of this reading, but flotation costs are to be added to I said shareholder, pardon me, are to be added to your initial outflow. But we'll speak to it in another part of this reading. But the way to look at it according to this shareholder CFA curriculum, and the proper way to handle your flotation cost is to take it directly away from, not directly, when I say directly away, is to add it as an outflow at the beginning of the project. Oluwatosin, I hope that answers your question. So just like in this place where we have CFO at the beginning, you also minus flotation costs. That's how to take care of it. Okay, that answers that. Another way to take care of, to make a decision around whether or not to take on a project is to calculate the IRR. What is IRR? IRR is that rate, that interest rate that equates the two sides of your investment. That makes your outflow equal to your inflow, which means that in this equation here, IRR is the K in this equation that makes your CFO equal to all of your initial, that makes your initial outflow equal to all of your inflows that you're going to have during the cost of the project. What is the decision rule for IRR? For any project that has an IRR greater than your cost of funds or your cost of capital. Cost of capital here can be WACC. In some cases, it might be higher or lower than WACC, depending on the peculiarity of the risk in that project. But generally, any project that has an IRR greater than your cost of capital should be taken, and anyone that has IRR lower than your cost of capital should not be taken. And this brings us to a hurdle rate. I've spoken to the fact that while the cost of capital is the proper thing to use, sometimes we have a hurdle rate depending on how risky the project is. So when there's a hurdle rate that the organization is working with, you accept all projects with IRRs higher than your hurdle rate, and then you reject projects with IRR lower than your hurdle rate. One of the key advantages that IRR has over NPV is the fact that it tells you in percentage terms how much value is being added. Because IRR itself is a percentage. Do you understand? Remember when I talked about NPV and I said that a 5 Naira project and a project that brings you 5 Naira and a project that gives you 5 million Naira in terms of value will have the same decision when it comes to NPV. But for IRR, because it is what you get is in percentage form, it speaks directly to the level of value that it brings to the to the shareholder value or to the value of the organization. One of the key disadvantages of IRR is that it can have a conflicting decision-making rule with the NPV. And let me explain this. In teaching students, I find that candidates always confuse this with whether or not higher IRR or lower IRR. This is the decision rule. For example, if you're doing a project or you're calculating the returns on a project, your IRR has to be, first of all, higher than your hurdle rate. Yeah. It has to be, first of all, higher than your cost of capital, right? And then your NPV has to be positive for you to accept the project. But what we mean when we say conflicting decision is that a project can have a higher IRR. Sorry, there are two projects. The IRR can be higher for one, yeah, and then the NPV might be lower for one. When it comes to that project, remember the IRR has to first of all be higher than your cost of capital. You have ticked off. That's one box ticked. Secondly, you must take the project with the higher NPV value. I don't know if that's clear. Even though they have, it might bring up a conflicting decision rule. Your IRR has to first of all be higher than your cost of capital. And then when you're comparing two values, you take the one that is more favorable given the NPV value. I hope that is clear. A lot of students always find this confusing. I hope that I've explained that very clearly. In terms of deciding on a project, what we're really looking at is what is the return on capital. Capital here is equity and debt. So return on capital is simply the return on all of your invested capital, and it's simply after-tax net profit divided by average book value of total capital. Remember, total capital here is debt, and equity. So in a question where you have to solve for your return on capital, remember that you're looking for a return on total capital, not return on equity or a return on debt alone. Apart from the return on capital, NPV, and IRR, there are also other things that one has to take into consideration when deciding whether or not to take on the project. There are options, and options are just like the options we have in derivatives. They derive from something else, but there are things that can make the project more valuable to you, much more than what you get on it. And I'll just talk through all of this. Timing option are options where there's time for you to, you can take your time in making a decision on the project. There's no rush to it. And taking your time might be able to give you an upper hand in making a decision concerning the project. Abandonment options are options where there's a possibility for you to abandon the project because the cost of abandoning is less than, it's more profitable for you to abandon the project than to continue it. Expansion projects are projects that you take on, but there's a possibility for you to expand in the nearest future. Flexibility options are options where, for example, you can increase your demand during the time that, you can increase your production when demand is high, or you can change your prices when demand is high, or you can increase your production because you know what, you can just decide to start paying staff over time to get more done for the project. And fundamental options are options in themselves, options for what you can do around the project. When deciding on the project, the capital allocation pitfalls. For example, how do you handle your sunk cost and your opportunity cost? Remember, sunk costs are not to be taken into consideration because they've already been done. They've been, I'll explain it now. They've been spent anyways. So when making a decision about a project, sunk cost should not be a deciding factor for you. Opportunity cost should be taken into consideration. Estimating cash flow should be done very carefully, because your cash flows, estimating your cash flows is what's going to determine whether you take the project or not. So if you have wrongly, for example, estimated how much will be coming into you, or what time the inflows will be coming to you, it means that your total estimation of your NPV and your IRR will even be wrong. There are also things around not generating enough ideas, or things around because management has a pet project, they're not really their emotions being involved in deciding whether or not to take on that project. That is all on capital investments, and we're moving on to working capital and liquidity. I think we're doing quite well with time. I'm not so sure. 12 minutes to go. If you have questions, please let us drop it in the chat box. I don't see any questions, so I'll move on very quickly. What is working capital? Working capital is really how you manage your liquidity to ensure that you have enough funding to take care of the day-to-day running of your business. What do you need to run your business? Talk about things like, when you sell your products, how long does it take you to take money back from your customers? And when you're buying products, how much time do your suppliers give you to pay money? All of these things affect how much money you have in your control to manage your business. Organizations that are larger usually have more access to funds. They can have committed or uncommitted lines of credit. Uncommitted line of credits are ones in which, you know what, the bank can say, you know what, based on so, for example, you have failed on some of the agreements we have had on the debt. I'm not going to extend this credit to you over this period of time. The committed ones are the ones where the bank doesn't have a right to change anything around what we have agreed on in terms of credit to you. Companies with weaker credits, usually they don't have this kind of access. I mean, even when they do, they usually need to post collateral and what have you. I see a question, taking that very quickly. 10 minutes to ethics. Wow, we've done so terrible with time. Okay, so moving on very quickly, it's really around how you manage the monies that you have with you, and you talk about how long does it take you to from when you receive from when you take your raw materials to the point that you get your funds. How long does it take for you to convert your money? And you start talking about things like your conversion cycle, your payables turnover, and your receivables turnover. You also speak to what are the forms of credit that are available to you. A lot of times, basically, smaller organizations have more lines of credit available to them, have less available to them, while bigger ones have cheaper sources of credit available to them. Bottom line is, as an organization, given what you have, manage your working capital such that it doesn't have adverse effect on running your business. The different sources of funding are the short-term ones and are the long-term ones. Short-term ones are usually ones where within a short period of time, you can get access to it and you tend to return it not so long after. There are also measures that drag on or pull on your liquidity. Drags are things that take longer for you to get your money, and pulls are things that make you pay money faster than you can normally do. There are also liquidity measures that measure things like how well can you pay back your credit and how long does it take you to convert your investment back into cash. We have a current ratio, quick ratio. I can't talk about all of them, but it really measures your ability to pay back your debt when you take them. And it also talks about how long it takes you to convert your investment from beginning to cash. Cost of capital speaks basically around weights of your different sources of capital and how we affect it. And under this, we have the propositions. Under this formula, cost of capital is just the weighted average cost of capital based on how much of those different sources of capital you have in your structure. For cost of equity, there are two ways. There's the CAP-M approach and the bond yield plus risk premium approach. CAP-M is really your risk-free rates plus beta into market premium. Market premium is market returns minus risk-free rates. When you come across a question that gives you market returns, you take out risk-free rates. If it doesn't give you market return, it might just give you market premium. This bracket here speaks to market premium. Bond yield plus risk premium is current market yield on long-term debt plus some sort of premium, depending on the risk of the organization. Moving on to beta. Beta is really your measure of systematic risk. That is risk that cannot be diversified away. Now, study has shown that from time, beta approaches 1. When you come across a question and your beta is 1 and you're asked to adjust your beta, what you need to do is this formula here: 2/3 multiplied by adjusted beta plus 1/3. Now, there are times where you have to solve CAP-M or something for an organization that is thinly traded, which means that they do not have beta. The way to do it is to unlever the beta of a closely related organization, most times a publicly traded organization or company. You unlever it. What your reason for unlevering it is to bring it closer to what the company that you're trying to get a beta for, to bring it closer to that organization's beta. When you unlever it by using the metrics of that organization, which is the publicly traded organization or the company in this case, you also have to relever it back by using the metrics of the organization that you're trying to get the beta for. So the process of unlevering is this. This is this formula over here. When you have unlevered, remember you have to use the debt to equity ratio of the publicly traded company in unlevering. When you're delivering, you use the debt equity of the company that you're trying to organize to estimate a beta for. In some cases, after unlevering and delivering, you find that your beta is close to 1. Then you still need to adjust your beta by using this formula up here. Back to the question that was asked. When new equity is issued, the flotation cost, as underwriting cost, should be included as an additional to the initial outlay for the project when calculating NPV or IRR. Now, moving on to capital structure. Capital structure speaks to what is the value of debt or equity you have in your capital. And I think one of the things that is most important here is the MM proposition. MM proposition is based on some assumptions. For example, there's no tax, there's homogeneous expectations and what have you. And MM proposition 1 says that regardless of the structure of your capital, the value of organization remains the same. MM proposition 2 is framed in another way. This speaks to cost of capital rather than firm value. And this says that even though it is generally cheaper to add debt in your structure, in your capital structure, over time, because debt has the higher priority in claims when anything goes wrong with the organization, or even generally, the cost of equity is higher. This proposition is saying that higher cost of equity eventually wipes away whatever cost savings you have from debt, from using more debt. Now, those are propositions 1 and 2, and these are based on the assumption that there's no tax. Now, there's a third proposition that says that there is tax. And once there is tax, remember in the formula for calculating cost of capital, because the cost of debt is tax deductible, MM proposition is saying that it's generally cheaper to have debt. So therefore, what MM proposition 1 with tax is saying is that the optimal capital structure is to have 100% debt financing. So you see the difference. Proposition 1 is saying that your firm value is, there's no difference. I mean, the value, your structure doesn't affect the value. Proposition 2 is speaking to the fact that whatever value you're going to save from reduced cost of debt is going to be wiped away by the increased cost of equity. And proposition 2 says that, so proposition 1 with tax is saying that since debt is tax deductible and is the cheapest form of capital, or your capital structure should be 100% debt. I wish I could go through all of this, but we will not move on. So I'm going to move on quickly to the last reading, which is measures of leverage. And it really speaks to the risk that you have in your business, and business risk and operating risk. Business risk refers to things that affect your operating income. What are the things that make your sales go down or your costs go higher? And operating risk refers to, really speaks to the amount of fixed capital you have in your structure. And sorry. Okay, this slide speaks to everything together. Business risk versus financial risk. In terms of your financial risk, you want to speak to operating leverage and financial leverage. There are different ways for each of them to calculate it. Generally, the degree of operating leverage is percentage change in EBIT over percentage change in sales. But for a particular level of sales, and this really speaks to what is given to you in the question. If you're giving your P&I statement, for example, you can just work this out. And because, again, it will mean giving your P&L for more than one period of time. You calculate the changes for both, divide them by each other, you get your degree of leverage. But there are times that what will be given to you in the question is your level of quantity of sales, the price with which you sold, variable cost and fixed cost. Depending on what's given to you, you can work out your degree of leverage, operating leverage, or your degree of financial leverage. Now, your degree of total leverage is the multiplication of degree of operating leverage and the degree of financial leverage. There's also something called break-even quantity of sales, and it's the point of sales that you have to get to be able to make up your returns. There are two sides to it. There's the break-even sale that speaks only to your variable cost, and there's one that speaks to both your variable cost and your fixed cost. So what is the effect of leverage and financial leverage on your business? Generally, leverage gives you higher returns on your business, but as it gives you higher returns, it also maximizes your risk, because when you're not able to return your debt as at when due, so many things start to come into consideration. But remember, when you're able to take on leverage, it means that the returns that you eventually have is shared with a lower level of equity. I'll give an example. When you take less leverage, it means that can we have some practice questions? I'm sure we can, and I would have loved to, but I see Yemi telling me that we have 3 minutes to go. I am so sorry. My number is 0813 124 3530. 0813 1243. Let me just type it in the chat box. And yes, I might not be able to take questions now, but I can always take on your personal questions. I'm sorry that the time is limited. Corporate finance is, corporate issuers is quite large, but make sure that you understand the major readings, what you need to know, and then how to take care of your different calculation. what equates to what and what doesn't equate to what, and remember how we affect your other parts of the reading. Please feel free to reach out to me. I wish we had more time to take up a few questions, but my apologies. But I hope I've been able to take up all of the 8 readings in a nutshell. Thank you, everyone. And I wish you the absolute best in your exam. So my number is on the board. So I'm sure, is Miriam in the room already? Miriam is taking us through ethics, and I will be here to learn a few things so that I continue to remember in my day-to-day operations that I'm liable to the CFA Institute Code of Ethics. Miriam, if you're in the room, kindly indicate so that let me stop sharing.
I am here.
You're welcome, Miriam.
Thank you. Well done.
I wish you, yeah, let me stop sharing. All right, everyone. Bye for now.
Okay. Hello, everybody. I hope you still have energy for my last session. It's a bit loud in the background because it's raining, but I'll try to shout. So let me know in the chat if you can't hear me by any chance. And the coordinators, well done, you guys. I'll try to keep the time because you guys are probably tired. It's been long for you, I'm sure. So got my slides. Let's go ahead. Brief introduction. My name is Mariam Kofi. I work at NDIC and I'm going to be taking ethics with it for you, ethical and professional standards, but I'll keep referring to it as ethics. That's just the short term of it. You all should know that, so don't be confused. So just with time, to be good with time, I'm just going to go through the notes quicker than you guys should know the notes. You have 2 days to exam, I just realized. So most of the theory should be okay for you guys. I'm going to focus more on us practicing questions because practice, that's what you need to get through your CFA exam. So a brief overview, if we go to the next slide. Okay, hold on. Okay, yeah. So ethics. I mean, it's the last topic you guys are taking today, but it is really important, as in ethics is going to show up all throughout your CFA exam journey. Like ethics is in all 3 levels. And it's really important to master ethics. Like there's 3 significant reasons. Like the topic weighting, it's huge, like 10 to 20% across the 3 levels. Number 2, it's transferable knowledge. Like if you really get your ethics, I mean, I know 2 days away if you haven't got it now, but if you have got it, it's gonna speed up level 2 and level 3 for you. So it's the same base knowledge that you're using. They just get in depth with it in level 2 and level 3. And number 3, that's probably the most significant thing that I used to think was a myth, but is actually true. It's on the CFA website. There's that ethics adjustment. If you are borderline, ethics can make it for you or break it. So you need to be with your ethics, like just understand it. Try to understand it. Don't ignore it. Go through it. It's not fun to read it. We all know the CFA charter holders will tell you ethics used to make me sleep, but as it says, you can see, I'm not going to read everything on my slides, as we'll be sharing the slides. I've quoted where the CFA Institute actually tell you the importance of ethics for minimum passing score candidates. And, ethics in level 1 covers about 27 to 36 questions. That's a lot of questions. So it's important. If you can get up that 70 above, it makes it so much better for you. I'm seeing, okay, I hope it's nothing to do with me. If anybody's writing in the chat, I'm trying to talk, so I'm probably not reading the chat, but if any of the coordinators put my attention if I need to respond to anything in the chat. So, I mean, ethics here in level 1 is topic 10, you all know, and it contains 5 learning modules. Excuse me if I refer to it as readings, because back in my days, it was called readings, but now they're calling them learning modules. Doesn't matter, it's all the same thing, right? So if I move on, learning module 1. So basically, learning module 1 is just an introduction to ethics, like general ethics, like in life, at work, professions. Like it's just telling you the common sense that we should all know, like what is ethics. And for the CFA ethics really is just introducing us to teach us about how investment managers should conduct themselves. And that's the code of ethics and the standards of professional conduct. And then secondly, we go into GIPS. You're very lucky. I mean, 2023, you guys have less GIPS. Like when I was studying, GIPS was a lot. So you guys are really lucky. GIPS is just, they really cut it down for you. So, but don't forget it, it's important as well. So basically, that's what learning module 1 is. I mean, question-wise, I feel like if you've been through the material, the actual CFA curriculum, you should be good for learning module 1 because it's an easy read. It's not too in-depth like when I looked at it. And they're probably, I mean, I don't know, I'm just saying from my opinion, unlikely to send you too many questions. And if you just use your common sense, you should be able to get through them. So we won't be going through questions to do with learning module 1 because they should just be straightforward questions that most will be fine with by now. If you've been studying for several months or even a year, you understand what ethics is. We have our own ethics even at home. So it's straight to learning module 2. If I'm going too fast, somebody do indicate if I'm going too fast, because I really just want us to do questions more than anything, because you should have known the theory by now. So I will go through, learn module 2. I'll give you guys a bit of a brief background, like a fact sheet. Like my slides can be notes that you can refer to because I've made them very detailed, although I will not be reading through them, as I said. So the code of ethics and the standards of professional conduct, like learning module 2 is the meat of ethics. Like it's the part that is what you need to know to get through that exam. It's probably what your majority of those 27 to 36 questions are going to be talking about. So what I want you to also remember, as I said, it's important to master ethics. If you master ethics, it will be that ace underneath your sleeve that will just get you through your CFA journey. Not forget level 1, it'll get you through all your levels. That being said, I mean, I know it's hard. I know you guys probably were daunted reading it, but I mean, for code of ethics, some people are memorization individuals that easily memorize this. I'm an individual that learns by understanding, so I never memorize these. I made a little short, if you hear me right now, I'm gonna tell you how I learned these code of ethics, if they're going to be useful for you. These are the verbatim what are from the curriculum that you guys have. But for me, how I remembered like the learning modules, I'm going to be looking down because I have my notes. This is what I used previously. I do not have that to memory. I got my CFA a few years, like 2 years back. So for the first code, I just remember code number 1, basically what this long sentence is saying is act with integrity and in an ethical manner. That's all. With public, with clients, prospective clients, with everybody. Like if you just live by that and you act with integrity and in an ethical manner, that's what 1 tells you. So whoever the case is talking about, am I acting with integrity? Am I acting in an ethical manner? That's what code 1 is. Code number 2, it's a bit short and easy for you to memorize if you want to, but as I said to you, memorizing doesn't come easy for all of us, especially me. So I always put things in my own words because it's easier for me to understand that way. So code of ethics number 2, how I remember it is place the profession and interests of clients over personal interests. I mean, place the profession and interests of clients over personal interests. Simply, that's what it's saying. You place the profession first, the interest of the clients over your own personal interests. That's what code number 2 is. Code number 3, a bit of a long-winded sentence as well. So I remember it as just conduct all professional activities, investment activities, recommendations with reasonable care and judgment. Like those keywords, reasonable care and judgment. Those are like the importance of code of ethics number 3. That's how I remembered it. If you haven't heard me, I'm going to repeat myself again. Conduct all professional activities with reasonable care and judgment. Simple. That's what number 3 is. I mean, you can create an acronym for this like I did, but I'm just telling you guys the short form what I used through all the 3 levels. Number 4, if I move on to number 4 is also not too bad. I mean, I just always speak different to others. Like I wouldn't remember exactly what the CFA Institute says, but I just look at it as work in a professional manner and encourage others to do. That's all it is, because it's telling you to practice and encourage others. So you work in an ethical manner and you encourage others to do the same. So basically that's what code number 4 is. If code number 5 is a bit like code number 2, it's straight to the point. If you want to memorize it, I tried memorizing. I always would remember promote integrity and I'll forget variability. And I'm like, okay, I would just do it my own way. My way is a bit longer-winded, but it's how I remembered it. I would say promote integrity of capital markets and support the rules governing the markets. Again, I'll repeat it, promote integrity of capital markets and support the rules governing capital markets. And then the final code, I mean, it's basically what it says is maintain and improve professional competence. Like just always stay up to date. Like all the coordinators that are listening to me now, they know the code of ethics, but preparing these slides also made me, you know, improve and maintain my professional competence on ethics. So that's all it's asking you to do. So those are actually the codes. And you see how CFA curriculum for 2023 did it quite interesting. Like LM2 comes before LM3, like which, I mean, I would say the code tells you how to do it and the standards tell you what to do. I mean, that's how they want to go about it. I'd rather tell you what to do and then tell you how to do it, but it doesn't matter. That's just my opinion. Don't mind me. So for the standards you all are aware we have 7 standards and we have subsection in each standard. And yes, you need to know all these 22 subsections. Like there's no way around it. You need to know. If you don't know and you're just 2 days away, okay, I'm not trying to scare you. It's okay. At least just know 2, because I think there's 2 standards that only have 2 subsections. So at least make sure each standard you have an idea. Like even if you don't know what it's titled, you understand what it means when they say knowledge of the law. Like you don't have to know like listing it word by word, because most of the times if you read the question, you would be able to explain, like answer it well if you understand. So I'm not going to go through all these subsections and tell you what they are. You should know this. I mean, if you don't, I'm not trying to be harsh on you. It's okay. You're going to be fine as long as you understand. So just hold on to your strengths and you'll be fine. But if you don't know, it's worth spending these, like ethics is actually good to read last because you need it to be in your short-term memory, because you need it to be like fresh when you go to the exam. So just spend some of the time that you have left, these 48 hours, or I don't know, you guys have 2 days or more, I don't know. So use that time to be very, you know, try to get as much as you can with ethics. Like it's important. Like the slides, as I told you, I'm not going to go through that. These are the rest of them, but the subsections are important. So that's LM. You see, we've been through LM1 and LM2 in like less than 15 minutes. So that's the plan. Now, LM3 talks to you guys about guidance for standards. So it's telling you guys, it's giving you scenarios if you read the text, and then it's commenting and telling you if it's violated anything or what it does. It's long. This is probably the boring part to read, but it is worth reading. It is definitely worth reading. The best source for ethics is the CFA text. Like forget providers. It's the CFA that's writing this exam for you. And if you actually make time to understand these cases, unlikely at the exam they'll throw you off, because most of them they've just changed a few things. Especially at level 1, you should be fine. In level 2 and 3, yeah, case studies come in, but like now it should be easy for you guys to understand. So we are going to do now, I mean, the guidance for these standards, as I told you, they give you scenarios and then they comment on them. So I've adapted those scenarios that they have and cases, examples in the textbook to create questions for us to go through right now. I'm not sure if this is okay. The coordinators can indicate to me if it's fine. How I want it to be is we're going to do questions now. But how we're going to have is you're going to have approximately 2 to 3 minutes for each question, I think, for the exam. So we're going to do the same thing. I want you guys to put in your answer when you have it in the chat. And once time is up, I'm going to give you guys 2 to 3 minutes. I mean, I might time you on my phone. I don't know. Or I could just use my head alarm. I'll just go dee when it's time for you guys to say it. But I want you guys to participate because I know you're tired. This is the last session. I want to hear your voices too. You've heard mine. You've seen me. I want somebody to volunteer to give us the answer. It does not matter if you're wrong. If you're wrong now, it's better to be wrong today. It's better to be wrong today than to be wrong on the day. So I will be looking out for volunteers, but if I don't get a volunteer, I might put somebody on the spot. And I don't want to do that. It's okay to volunteer. We all get things wrong. I mean, I learn from my mistakes more than anything. So let's go on without any more introduction. So let's go on with the first question. As I said, I'm going to give you guys 3 minutes, 2 to 3 minutes, have a read, and then start putting in your answers in the chat. I'll keep my camera on. I'll stay on with you guys. And let's go. So we've started at 45 past. So 47, 48, I should be expecting you guys will stop. So Good. I've got somebody already responding. That's quick. We'll wait for a few more. Great. Okay, it's like everybody's swaying towards the same answer. Interesting. Let me give you guys maybe a minute more and see where I go. Okay, there's somebody else. Good. There's a variety now. Good. So 2 so far, 2 options. Okay, finally, the third one. So we have all options being selected now. Interesting. Good. Okay. Notice somebody changed their option. No, she changed it again. Okay. Interesting. Just read it. You've got like a minute. I'll give you a minute more before I wait for the brave individual that's going to start this up for us and volunteer themselves. See that superstar? Good. And you guys are good with time, so you should be good with your exam because you're answering questions so quickly. Time should not be an issue, and that's always a plus. Okay. Okay, it's been 2 minutes. So do I have a volunteer? Can somebody put their hand up and volunteer to tell us why they chose their answer? Introduce yourself briefly, your name, tell us what answer you chose and why. That's all. That's all we're asking for. Let's see who's going to be the brave individual that's going to put. You can, if you put your hand up, then you will be able to.
Oh, I just enabled,
Okay.
They should be able to unmute themselves. So just go ahead and unmute yourself.
Okay, so we have Mariam. She's got a hand up, so she can speak. Oh, it's good. My namesake wants to speak. Go ahead.
Okay. Hi, good evening, everyone. Hi, Mariam.
Okay.
So my answer is A, no. And basically it shows the question shows that Alan made a mistake due to his presentation, but in no way has he violated any wrongdoing because he only sought the advice of a brokerage firm's general counsel. And then the brokerage general said, oh, okay, the situation doesn't show that it can prove his wrongdoing, but he has not made any decision regarding that. So in order not to assume anything, I just go with A.
Okay, thank you, Mariam. That's good. Well done. So yeah, so Mariam says A. I have a variety of all the answers. I'll just let one person speak and I'll go through it to you guys. So you said A, yeah, that's great, Mariam, but just because you have sought advice for counsel and that tells you you're not unlikely to be found of wrongdoing. I mean, if you've stolen and somebody knows you've stolen, just because you're unlikely to be found of wrongdoing, the law doesn't care. Like you go to court, you stole, and there's evidence that you've stolen, you'll be accountable to it. So it's not A, he definitely has violated something because that doesn't, as a CFA charter holder, you have to be aware, you have to have knowledge of the law and regulations and you need to follow them. Yes, you should seek advice, but you can't stop there when you know something is wrong. He didn't intentionally do it in the first place, but it happened. So what are your next steps? So it's not A, but well done, Mariam, for your understanding of it. The answer is actually C, professionalism. As I mentioned to you, knowledge of the law. You should have knowledge of the law. So this is the comment directly from the CFA site. So although it is recommended that you seek this legal advice, as I said to you guys, reliance on it does not, like, it doesn't, yeah, you still go to jail if you still get in trouble. So is a requirement for you to comply, as I said, and he should have done further, like he could seek supervisor, seek an independent legal opinion. So that he should notify that an error happened. Like he didn't do it out of, spite. So he has definitely violated a standard. I mean, I've already broken the answer to my question follow you through. I've told you guys his knowledge of the law. So the subsection this is under is standard 1, professionalism, and it's under the subsection A, knowledge of the law. So, I mean, that was excellent. Well done, guys. I'm going to move on to the next question. So we have the same time, about 2-3 minutes. Do I have any questions? Okay, why B? Okay, why not B? Let me go back. I didn't see that. Okay, Brian, I'm going to answer you. Why not B? So B is relating to performance presentation and misconduct. You see the key word here is misconduct. As it says, Alan, his intention was not to, overstate the issue. It's like misconduct is when you intentionally actually do something that you know is wrong. Like he made a mistake. He knew, that's why he sought brokerage firms counsel. So he didn't intend to. So there's no misconduct in it. And so also it's not relating to performance presentation because it's not like he's represented some performance incorrectly. So I don't know, is that clear to you, Brian? Because I think you're the one that asked why not B, so we can move on. Okay, I think so. Okay, great, Brian. So Brian understands, nobody else has said anything. Oh yeah, okay, yeah, that's good. So I'm gonna move on to question number 2. Hopefully none of you noticed I dropped the answer by mistake. If you're one of those sharp people, still please read it. Okay, yeah, we have 2 to 3 minutes to do this one. Shoot, I don't know why it's clicking. Sorry, guys. I don't know what's happening with my screen. I'm trying to get rid of something that's popping up on my screen right now. Yeah. Yeah. I hope none of you guys are saying it because I made that mistake. Chinedu has raised their hand, so you probably be with the individual that I will let tell us why. What's this? Somebody saying, can you just drop our answers in the chat to tell us the correct answer, explain why it's correct. That's where we can move to the question. I could do that, sorry, Jacob, that you're recommending that I just go through it. Personally, for me, I mean, if majority of you want that, but for me, I've done these webinars before and I actually learned from making mistakes and offering, because that's how I would never forget a question that somebody has explained. I mean, and it's also, I think it's easier for you to learn from your peers as well. So, and I am time aware, I'm being very timely. Hopefully we'll get to go through all the questions I have ready for you. If I feel like we're behind with time right now, as I've planned it, is going as planned, I will decide to just keep talking, but it's important for us to like participate. You've been listening to so many different people all day, so I feel like it's nice, refreshing, you know, to just be able to speak. It wakes you up as well to be there, Jacob. So I mean, give it a try. We'll see if I get another person saying the same thing as you, I will follow suit. Okay, ND is saying the same thing, that both the wrong ones and the correct ones, so we understand better. Okay. Okay, I'll go through every option for you then going forward. Noted, ND. Okay, I think we've had more than enough time for question number 2. So I think I remember who Chinedu, if he can be on, you can unmute yourself and speak.
Hi, good evening. So yes, the answer is C, relating to material non-public information. And this is because Zito got a material non-public information and acted on it, as well as sent this information to her relatives, and possibly they got profit, or they made some profit from the transaction. So,
okay.
Yeah.
Thank you, Chinedu. So, I mean, if everybody heard what Chinedu said, I'll go through each option. So the first one is saying, majority of you actually, I mean, have I seen any A? Yeah, I know you saw the answer already. That's why I said hope nobody follows that. So I haven't seen anybody or noticed anybody that selected A, but we'll still go through option A. So option A is it's an easy elimination because there's nothing about priority of transactions being mentioned here. There's no transactions being mentioned. It's just information that's being shared. So priority of transaction is when you prioritize a certain client or a certain portfolio via over another. So A is an easy elimination for you guys. So even if you don't know, normally I think especially level 1, there's always like a 50-50 chance. So B, that says no, that she hasn't. We had a few people select B, that no, she hasn't. Okay, so I think we're gonna, from now on, Yemi said as well, we'll just keep going through the questions. I'll give you guys time to put it in the chat and I'll just explain it. So that has been seconded by even the coordinators, so that's fine. We can go ahead like that. So as I was saying, so question number 2, B, that selected, people that selected that she did not violate anything. She's sharing information that she knows is not public, and she's acting on it and giving it to somebody that can act on it. And she knows that Clement is a portfolio manager that is about to share information that is going to be public knowledge that was not prior. And he's just sharing it with her just before, and it produces. So definitely she has violated something because she knows it's private, privy information, because he would have sent this information before coming for the program if it was public information, and he wouldn't even need to come to the program to actually share the information if it was just general public information. So definitely, yes, it is relating to material non-public information because she's sharing it and she's acting on it. So Zito is wrong, definitely, for sharing this. So the answer, okay, Mariam is saying Clement, yes, that's a good one, Mariam. Clement also violated, yes, because I mean, if he knows there's a possibility that it can be acted upon, he's also violated it. So if this question had the option for you guys, has Zito violated or has Zito and Clement, if there were the options? If it was just Zito, Clement, and then Zito and Clement, the answer would be Zito and Clement have violated it. So that's why I actually chose this question, because it can come the other way around, and that's really good you guys picked that up, because he has as well, because he knows even though it's just close to him sharing the information, it still can. So I think Maybelline, because I'm told not to mute you guys, maybe type your question in the chat. I notice you put your hand up because I'm reading the chat at the same time. So if you type your question in the chat, I'll try to answer it. So yes, Mariam is right, Clement has as well. Zito is a journalist, not an investment professional. Can you explain better? She's an individual that is not a journalist, yes, but she's getting information from somebody that she knows is in the industry, somebody that is actually somebody that knows things that are privy that others do not know, even though she knows, because that's why she has violated it. Maybe the people acting on it, getting the information from her, may have not violated it because they don't know. She's just a journalist. But then at the same time, there can be an argument that she's a journalist, she has privy access to people that know what happens in the market. So I hope that answers your question. I'm just checking if I've missed any other question. Would you say Roger also violated the standard? Okay, so Roger also acted on it. If you take information that you know that person has access to possible non-public information and you act on it, yes, you probably have violated it, but it's never a vague, like, what's it called? Roger, okay, Clement, yeah, sorry, Clement is Roger, right? Sorry, confused there. So Roger definitely has violated, as I said. It's never like a gray area when they ask you these questions. It's either a right or wrong answer. So definitely Clement, Roger, the same person, has violated it. Zito, Mary Zito has violated it. So acting on any non-public information or sharing it to anybody that could act on it, even if it's just a minute before he broadcasts. Now that we have social media, somebody can easily send a message and it'll just be going around before you know it. So definitely there has been a violation of the standards here. Okay, I'm just checking if there's any more questions in the chat. Okay, the Q&A is also alarming me. Let's see what's that. Oh no, there's no question there. So I think, are we good with this? Is there anybody that has a question, or should we move on to question number 3? Just somebody indicate in the chat so I know there's nobody that I missed their question. Okay, I'll assume so, yes. Okay, we'll move on. Thank you. Thank you, guys. So question number 3. Take your 2 minutes that we said and have a read. Okay, I'm seeing some responses already. That's good. Okay, I'm getting, it's all swaying towards the same. Yeah, everybody seems to be that has answered so far is swaying towards the same answer. Good. I'll give you guys a minute or so. Yep. Okay, one person. Good. There's now a very variety of answers. Always good to see that. Okay. Very good. I'll give you guys just under a minute and see what happens. I mean, I think majority have sent their answer. So even if you're not sure, like this is the time that you can just, you know, guess. It doesn't hurt to just guess. If you haven't put in anything, it's worth putting something and guessing. Because you've already read the question and you should have like a idea as to what it is. It could be. So yeah, okay. I mean, okay, that's great. So yeah, let's talk about it now. So nobody selected A, I noticed. Nobody selected A because loyalty, prudence, and care is under the standard to do with clients. So there's nothing here that's showing that Moody has done anything that is not against loyalty, prudence, and care. Loyalty, prudence, and care tends to be more related with managing clients' portfolios and following their actual, risk ability and the investments that they've agreed that they can invest in. Oh, okay, somebody's put A. Okay, that's what I'm explaining now anyway. So yes, so this doesn't really fall in that because we don't really know what Moody's clients, what her risk management portfolio is, what her ability, her willingness, and what her portfolio return target is. It's nothing to do with that or her preference or anything about her. We don't really know much. Or we know that she wants to, reduce her taxes by, investing into charity. So A is the first one that you would knock out. So only got one person that selected A. So that's why A is not correct. I'll go on to C because majority have chosen B. So C is saying that Moody didn't violate anything. Some people did choose that. For her to share information, I know she's doing it for a good cause, that she's trying to make the charity and the client, but she's not supposed to do that. The information about the client wanting to do that is privy information to her. It's not actually something that is just public knowledge that the client was okay with her sharing with anyone, unless the client says, if you do get an opportunity, you can send them my way. There's no excuse or reason. You should always keep client information confidential. So that's why C is not the answer. And majority of you did choose B. Yes, B is correct. B is the answer because she's sharing confidential information about her client to the charity. Although she's doing it for a good cause, you still are not meant to do that. So that's question number 3. I'll move on because I think I've stated she did not share information, she just advised. Okay, she did, well, that's sharing information, and she's advising them to give her a call. Because why didn't she advise her other clients? Is because she knows that that client in particular is actually interested in reducing their income tax. So that's why she shared it. So, and she knows that if they do call that client, they will get what they want. So that's actually sharing confidential information, because there's no way you have a portfolio full of many clients. She didn't give them their contact, but she's insinuating in any way of sense. If you're insinuating that, okay, go to Miriam, she'll help you out. Like, you're saying that Miriam has access to somebody that could do something for you. Like, you wouldn't just send them to anybody. So that's, you have to, like, even if you're attempting, like it says, even though it's well intended, you're revealing something by sharing. So even something as small as this is actually, when you're in doubt, because like we see, we're arguing that some people are saying the client has not asked for her help to find where to donate. Yes, so that's the reason Isaac is saying, yeah, the client did not ask her. He's just saying that he intends to. She knows that intention. For her to share it with the charity is actually revealing a confidential information of the client. If she mentioned the conflict of interest, she can't, the only time she can do that, as I told you, is if the client has it written saying that, oh, if you do get any charity, you can tell them to come, send them my way. Then it's not, that's how this question would change, that it's not a violation. But other than that, if that's not stated in the question, it's a violation of confidentiality. So what she should have done is she could, because she knows the information about the charity and the charity is not her client, Chinedu, she can actually talk to her client about it and say, oh, I know this opportunity. Are you interested in it? Can I send them your way? That's fine. She can do that because the charity is not her client. So that's the course of action she could have gone without violating any of the CFA standards. So I hope that's clear. Is that clear for everybody? Should we move on? Yes, no, maybe? I'm going to move on. So question number 4, you have 2-3 minutes. Let's see. Let's go. Mm-hmm. Okay, have some responses already. You guys are quick, that's good. You're still awake, you're not tired after the long 2 days. That's the kind of energy we like. Variety, you've got all the options being selected to this question. Interesting. Mm-hmm. Good. You've been done quicker than anticipated. This is good. So we have time for questions up there. You guys are going fast. Speedy compilers. Okay. I'll just give you guys just under a minute because majority have actually sent in their answers and then we'll go through it. Okay. We're almost there. Mm-hmm. I think, yeah, okay, that's, yeah. Okay, I think, yeah, majority of you sent it in. If anybody hasn't, quickly send it in now if you want to speak before we start explaining. So this is also directly from the LM3, I think, yeah, the guidance one, LM3. So this is a case, if we go in reverse order, so if we option 6C says she's violated the standard. Hold on, I'm having a bit, I don't know why she's violated the standard. Hold on, I think I'm having a bit of a difficulty viewing my screen. There's like I don't know if it's Gloria, if you're there, I've got like a drop down. I've clicked on the Q&A and it's got like a drop down blocking my question. I have no idea how to get rid of it. It's already...
The Q&A, there is an X sign at the top right of that Q&A.
Top right. I see like settings when I click
yeah.
there. I see like a setting sign, like a mechanical...
Oh, just on top of settings, there's an X. If you hover on the X, it turns to red. You just click on it, it's going to close the dialog box. Is it working? That's what is showing on my own screen, just on top of the settings button.
Because whenever I click, it goes to the answer. That's why I don't want to do that. That's why I was asking you now. I don't know why. Can I just quickly just stop sharing a second and then come back on for you guys a second? Let me, yeah, now I can get rid of it and I'll stop sharing. Yeah, like that, that's it. Done it. It was on the top left for me. Okay, we're back. So yeah, so I'll go in reverse order as I was saying. C, people that chose C, it violates standard relating to competing with the employer. So her registering with her investment company without noticing her employer, like with government authorities, if it's all depends. We are not given too much information here. We're not told if she registered while she was on the job or she's doing this in her spare time. So if they're quite vague and there's a benefit of a doubt situation, like we can say that she is competing if she's doing it in time, at the time she's supposed to be at work, or she's doing it in her spare time. When there's always, benefit of the doubt situation, it's unlikely that you're competing with your employer. Like it's very clear when you're competing with your employer, if you're at your desk and you're trying to use the information to get clients, or if you're at your desk and you're copying models from your company, you're definitely competing with your employer. So that's the reason why it is not C, because it's not too clear. Like they've just said that she's registered and she will compete with her employer, but it doesn't say that she is already doing it. She's just intending to do something. She hasn't started doing something. So that's why she doesn't violate standard 4A relating to competing with the employer. For option C, that's why it's wrong. So if I go to option, okay, let me see. I think there's no standard for competing with employer. I don't know. Okay, I feel like most of these, hold on. If I was to go back to the standards for you guys, which I can easily do. So it falls under loyalty, prudence, and care. And this is what I'm telling you guys. You need to know all those 22 subsections within it. If you read the subsection about loyalty, prudence, and care, competing with your employer, if you're not loyal to your employer, that's when you compete. So is also under it. So that's the trick. They might throw something like this at the exam for you, and you're supposed to know that. They won't say loyalty, prudence, and care. They could easily just say relating to competing with your employer. CFA can throw that at you. So that's why it's important to understand what it means under each subsection. I've just given you the heading, but if you look at your text, because this is directly from the textbook, so it is actually underneath that. I think that's the question that we were just asked. So option B. So option B, okay, is also relating to loyalty. So I did that intentionally. So you see somebody picked that up. I just remembered now. I did the slides a few days back. So yeah, it's the same thing. B and C mean the same thing if you read your curriculum. If you know your standards in and out, it's the same thing. So that could easily happen in the exam, whereby the two options are actually the same, mean the same thing. So you can easily it's like a question you can get done in 30 seconds if you, as I said to you, if you master ethics. It's really going to be an ace up your sleeve. So the answer is A. She does not violate any CFA Institute standard of professional conduct, because just because she's registered her company without notifying her employer, and she intends to start an investment firm that will compete with them, but she hasn't sought any of her clients to be part of it, doesn't mean she's violated anything. Because like I said to you, we give her that benefit of the doubt. Maybe she's doing this in her free time. And maybe when she gets to the level whereby she needs to inform her employer, she will. So she hasn't actually violated any of the standards. As the comment says, this is exactly verbatim from the CFA curriculum. She's not soliciting. She hasn't actually, she's not operating it. She hasn't actually left her current employer and she hasn't started operating it. So there's no conflict of interest for her and her employer. So this is a tricky one. And that's why I kind of put it when I saw it, because it's one of those ones that if you're under pressure and you're in the exam, you could easily select the wrong answer. So I hope any questions to do with this so we can move on. Wow, we got like less than 15 minutes to go. So I have a few more questions for you guys, and I want us to talk about GIPS quickly and ask you a question. So if no more questions come, 1, 2, 3, okay, I'm gonna go on to number 5. So question number 5, have a read, select your answer, and you've got, the quicker you do it, actually, the better for us, because I got a few questions to go. Just read the words for this question. This is what used to always catch me out on my CFA when they use that word, most likely, least likely. So make note you understand the question. Okay, good. I'm taking this question, taking a bit more time. Yeah, I have somebody. That's good. Again, response. Good. Okay, that's good. We've got a variety. All the options are being selected. I'll give you guys just under a minute because I want to make sure we cover 2 more questions to do with the standards, and then I have very few to do with GIPS, and I want us to be able to get through that. These poor coordinators have been here with you guys all day long. Okay, Isaac is like ride or die. Okay, great. Confidence, I like that. The answers are confusing. If you read it slowly, this is how sometimes they will confuse you in the exam, Chinidu, trust me, especially when you're stressed. So read it slowly. Least likely violated. So that means, great. Okay, I am about to, let's discuss it. Anybody that hasn't, just throw it in. So again, in reverse order, C. So the question is saying least likely violated which standard? That means she has violated 2 of the standards listed in the options, and 2 of them are violations for sure, and 1 is not a violation. That's going to be the correct answer. So when they say least likely or except is one of those wordings that could easily confuse you when you're under pressure. So option C is saying she's least likely violated investment analysis recommendation and actions relating to communication with clients. Has she least likely? She's not telling her clients and she's changing things about their portfolio. She's not communicating with them. So she's definitely violated that standard. She's just decided to do something that, okay, I've been told I've got 10 minutes to go. We have to be quick. So she's violated that because she's communicating. Again, this is another one like question 4. B and C are actually under the same subsection. Like you need to do relating to disclosing information. That's what it's supposed to be. I think I should have put disclosing information, but they also put related to disclose. I saw that in one of the questions. I've just used your curriculum for this, to be honest. So sometimes it's the same standard she's breaking. If she's disclosing information to clients, disclosure is what I wanted to write instead of disclose. I'll correct that before I send the slides. So relating to disclosure, so she's definitely violated that standard. So the answer B, is no a subsection relating to B. What do you mean relating to B? There is a subsection. As I tell you guys, Miriam, it's not exactly named as you said it. If you read through it, you guys need to be checking those explanations. LM3 is guidance, which means every subsection, they're telling you what could fall under it. You'll see this case, if you go back to your textbook, every case that I've used here are straight from the textbook, and they'll tell you the same thing. So A is definitely right, because it's nothing to do with suitability. It's not like she's decided to go into more risky investments for the client. She hasn't decided to to put the client at risk or go above their willingness or ability. So the answer is definitely A. Because we have like 10 minutes to go, and I really prefer you guys do these questions now. I'm going to swiftly move on to number 6. Hopefully nobody has any questions. Let's go on. Number 6. Okay, yeah, the explanation, I've already said it to you, so yeah. Number 6, another least likely. So read it slowly. These are the questions that catch out candidates, in my experience anyway. And notice that this doesn't really talk about standards. It's telling you any of the actions or activities, and they can do that to you. They won't necessarily say a standard. They can throw this at you. So you have to be quick, because the next question, and I do want you guys to look at gifts, because we can't forget gifts. So let's be quick, people. If you know the answer, throw it in. Time goes quicker than I think. I thought we'd be good with time. Good. Yeah, sway towards, I think, sway towards one answer so far. Just one other individual challenging it. So let's see. You guys are, Yep. Just give you under a minute quickly. If somebody's raised their hand again, can you write it down in the chat, because we really don't have time now. If it's a question, write it down. I've seen a typo myself. If that's what you're pointing out, I'll correct it before I send it to Gloria. Okay. Go ahead. So, okay. Send it in, whoever has whatever it is, because I want us to be able to do question 7 yet. Okay, good. So let's go in order this time. So Gary has been doing some interesting things. He's been living this lavish life, and he's not even signing his company agreements that he's supposed to be doing. He's just been doing what he feels like, and he's an entry-level employee, and nothing has been done. So which one has he least likely violated? So placing personal transactions ahead of client transactions, that's definitely a violation. We all know that. Like, that was one of the things I was reading out to you guys on the code of ethics. So that's definitely a violation. You do not place your own personal transactions ahead of clients. Clients always you're supposed to put the profession, the clients, then yourself, as I said to you guys. So that's a violation, A. B, supervisors permitting him, like the failure of him signing this personal transaction form, which is a failure on the side of the supervisors. So that's actually definitely a violation, because they need to ensure that he's signing it for him to carry on working. So that's a violation of the CFA standard from the supervisors. Is there evidence of this in the facts? Evidence of what are you asking? Let's Sony, if you can elaborate, evidence of what? Anyway, so that's why I'll wait for you to say that in the chat. The supervisors are definitely, Michael did not attend the client, but carries on his own transaction. Do not attend, place of clients. Yeah, it does say that he's placing clients, he's placing his own investments, you know, Michael made substantial investment gains by purchasing stocks just before they were put out. So he's purchasing stocks before the firm puts it on the recommended buy list. So that's placing personal transactions ahead of clients. So that's definitely stated there, clear outright. And so I hope that explains it if you read it. It doesn't have to say verbatim what the answer options are giving you. It's making sure you actually have read the question and understand it. So they could write it in a different way. That's why I even put it that way. So supervisors are definitely permitting him, that's wrong, because that's the responsibilities of supervisors. That means they're breaking a standard clearly. So the answer is definitely C, as you guys all said. Like, just because he has substantial investments that you purchase for clients, that's not a violation of the standards. You're allowed to, as long as it's disclosed and you don't use it to put yourself ahead or put your interest ahead of the client. So definitely C is the answer. Because of time, I mean, I do have a question 7, but I'm going to leave it because you guys will be fine. This is just something to do with claiming the CFA standard. I'm going to quickly move on to GIPS because GIPS should not be forgotten. It's actually really important as well. So LM4, if you do have questions, obviously you'll get my details and you can send it afterwards, obviously, after the presentation. LM4 is an introduction to GIPS. As I said to you guys, you are so lucky. You don't have too much GIPS to have to learn compared to when I did it. So basically it's telling you why is it created, whom it applies to. It's actually an easy read. I would recommend you guys make the time to actually read this from the curriculum. That's why I didn't bother to make notes, because it's just 4 subsections they've done and they go straight to the point. And on that note, I was going to explain it to you guys. I'm not going to spend that time because you're so close to your exam. You should know the answers to all these questions that I put and the subsections. I want to just do the question. I mean, at least one of the questions, because we have really limited time now, under 5 minutes. So I've placed all the questions on the screen, but let's answer question 1, please, together first. So read question 1 and then put your answer. I'll give you a minute because I really don't want to keep these organizers any longer than they're supposed to be here. Although, okay, question 1, yeah, great. Quick, you guys, just be quick on your toes because these ones are straight to the point. And GIPS is easy because it's what they tell you is what it is. There's no gray areas. Good, great. We're swaying towards one answer. That's great. Amazing, guys. Yeah, really fast on the keyboard. That's really good. Okay, one person that's got a variety now. Good. We have somebody that's got a different answer. Come on. Less than a minute. I'll discuss this with you. Okay. Throw it in, give it a guess. That's it, time up, okay. So question 1, as you can see, I'm that person that likes throwing that least likely, and I think you guys have got the hang of that least likely now when you're reading. So if we look at it in order, so these are the objectives. The GIPS has listed objectives. So you should know these objectives. They're verbatim from the GIPS objectives. The whole reason why was it created? To promote global competition amongst investment firms. That is listed in one of the reasons why it's why GIPS was actually created, the standards. So A is definitely an objective, so it's true. So it's least like it is an objective, so it's not the answer. B, promote investor interest and instill investor confidence. That is also verbatim from the GIPS standards. That's what it's supposed to do. It wants to promote like across different investment firms. It wants to promote investor interest and instill confidence in the process. So B is true. So B is definitely not the answer. And majority of you said C, which is great, amazing. If you didn't, it's fine, because the way I put it, you would think it's possibly it's supposed to be a standard. No, GIBS is not a regulatory requirement. GIBS is voluntary. It's optional. It increases your credibility as an investment manager, but it is not regulatory at all. It is optional. So that's the beauty of GIBS. Yeah, amazing. You guys have said, most of you have said it. I mean, it's 6:30 on the dot now, but none of the organizers have said anything to me yet, but I'm not going to push it because they've been here for a long time. 2 and 3, you guys can give yourself a try on 2 and 3, because they're also questions that are straight to the point. But as I said to you, please refer to GIBS. Like, look at GIBS. GIBS is 3 is not asking, okay, what are you doing? Okay, some people have already answered the other questions. That's amazing. I wish I could go through it, but you'll see the answer when you see the slides. That's good. You guys have answered all the questions. I mean, yeah, I can tell you the answers for them. Okay. For question 2, which of the following is not a requirement of the GIBS for composite construction? Not a requirement. That's the key word. That's why I put it in italics, not a requirement. B is the correct answer. And I think, yeah, majority have said B. Yeah, B is the correct answer. And that's amazing. The others are just listed. If you read the composite construction, it's straight to the point. It's listed on the curriculum. Number 3, which of the following is not correct about verification? Not correct. The keyword is not correct. So verification must be performed by an independent third party. Is that correct? Yes. So the answer is not A. Like, verification must be done by a third party. A firm cannot perform its own verification because you need to be, it's not correct. That's not correct. Like, okay, that is correct. Sorry, that is correct. Sorry, correct me. That is correct. A firm cannot, because I just said it has to be done by a third party. So that's correct. So C is the answer for 3. Verification ensures compliance of specific composites and departments. No. Verification needs to be firm-wide. They say it clearly. You can't do specific composites or departments. It has to be firm-wide verification. So C is the answer for 3. And now I don't want to go over my time more than that. I mean, you guys will see this when I send it to you. I did want to go through this with you guys, but these are my top 10 tips to knock out like all your level ethics. I mean, read through it. Any questions you have, you can send, I mean, you can get my email. I'll give you guys my email. I'm not very good with my phone, but I'm better with my email, which is really odd. Yes, excuse me for that. So these top 10 tips, do read them, because one that I would definitely tell you guys is number 7. If you are somebody that learns visually or by audio better, it's worth listening to these videos. They're on the CFA website. They're 10 to 15 minutes long, and they explain it. Instead of, now that you guys don't have time, is not in your side, instead of going through all these guidance notes that I'm telling you that are in the textbook that could take a long time to read and also to actually understand, those videos are actually really good. They're really short and straight to the point, 10 to 15 minutes. They're on the website. Even if you're not registered, like anybody can view them, and they actually go through all the standards. And as I said to you, the CFA examples, if you have time, last few days, you're feeling you've done all your questions, you've covered all the topics that you spent yesterday and today doing, do look at these CFA ethic examples. Ethics is definitely worth it. I mean, most people think, oh, it's just boring. It's boring, but it's really important. And it's important to use the CFA text. CFA will create these questions and then use those end of chapter. Make sure you've done the end of chapter questions. Use your CFA online. And then if you have extra time, look at third parties. Third parties are not the best for you. That's why all the questions we've done here, I've taken them from the CFA text, because that's the best way, because third parties can misconstrue things for you, either make it too difficult or too simple, and you'll be upset after the exam. But apart from that, I've gone 5 minutes over. That's it from me. I really hope it helped. I wish you guys all the best of luck, and you'll be fine. This is just the beginning of your journey. Relax, just have confidence in yourself. You've come so far. You've worked really hard. We've all been through it, and you're going to be great. You're going to be fine. You're going to be those first-time passes that I'll say I know. So Gloria, back to you. I think I am done.
Maya, thank you very much for a wonderful 1-hour session. And yeah, you did your best to cover as much given the time constraints. Thank you so much. And on behalf of Civil Society Nigeria, the board members, and the membership committee, I would like to say thank you to you and other facilitators that have taken out time on your busy weekends to attend to this bootcamp. And to all the CFA Level 1 candidates who joined this session, we wish you all the best as you write your exams this week. Lastly is that an email has been sent to you right now already. So if you registered for this session, definitely check your email. If you don't find the email in your inbox, please check your promotions or spam folder just in case it went there. So the email is like has the link to the feedback survey for this bootcamp. At the end of the feedback survey, you'll see a folder that has the slides from all the facilitators. So we've not gotten all the 10 slides because we've covered 10 topics. But that's why I shared a link to the folder so that as I upload the slides between this night and tomorrow morning, you'll see all of them. Right now, there are 3 slides there, ethics is there, fixed income and portfolio management. So as we get more, I'll upload to that folder. So please feel free to check back. And also the link to the recording is on our YouTube channel. I've included that in the email I just sent out. So for all the subjects we covered from yesterday till today, they are all they were live streamed on our YouTube channel, so you should be able to watch all the sessions over again as you prepare for your exams. That'll be all for now. Thank you everyone and all the best. We are waiting for you. Any last minute questions? Received. So for the slides, like I said, check when you click on the link to submit your feedback for this bootcamp. Once you submit the feedback survey, you'll see a link to download the slides. So just click on the link. So check your email, all the instructions are there. For those that did not register, can you send an email to us? Then we'll let me just drop our email address.
Fine, thank you.
Okay, let me drop my direct email address to make it faster. My work email, nigeria.eden@nigeria.cfasociety.org. Okay, I've just shared my email address. So just shoot me an email. I'm going to check it maybe in the next 5 to 10 minutes so I can just forward that email to you all. So I'm just holding